New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while giving you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Friday. Let's take a look at market movements so far. Futures ticking slightly higher after AI darling Nvidia sent stocks higher on Thursday. The S&P 500 recording its biggest gain in more than a year, closing up more than 2%. The tech-heavy Nasdaq Composite closing up nearly 3%. Assessment of the Federal Reserve's next interest rate move. That is going to take a backseat, at least for now, to Nvidia's stellar results here.
Well, investors are also parsing through a slew of earnings reports here today. Block and Carvana surging on upbeat results, while Warner Brothers Discovery declines. All trending tickers here on Yahoo Finance's homepage. So let's get right to it. The three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Rochelle Akufo, and Madison Mills have more.
Futures are taking a breather this morning, coming off the Nvidia AI-fueled rally. Both the S&P 500, Nasdaq 100, and throw in the Dow Jones. That closed at all record highs Thursday, and that's thanks to the AI darling's blowout quarterly results, which beat sky-high expectations. And while Nvidia's results reassured investors about the strength of the AI mania, traders are weighing warnings by Federal Reserve policymakers about cutting interest rates too soon, potentially putting the soft landing at risk.
And of course, big news in the IPO market. Reddit officially filing to make its public debut. The social media platform plans to list on the New York Stock Exchange under the ticker symbol RDDT. And this would be the first social media company to go public since Pinterest debuted back in 2019. In a rare move, though, the company is offering Reddit users who've, quote, meaningfully contributed to Reddit community programs the opportunity to buy shares at the IPO price. Now, usually with IPOs, that's reserved for professional investors. Sources familiar with the matter say the IPO will likely come in late March.
And Warner Brothers Discovery posting disappointing results. Those shares down over 10% in the pre-market trade this morning. This comes after the streaming platform missed the street's revenue expectations for the quarter. That was in part due to those strikes in Hollywood. Now, the company's weak ad revenue was also weighing down shares. Having said that, some good news. Its streaming service Max did post profitability for the first time ever.
We're wrapping up another busy week of corporate earnings here. Futures just slightly higher this morning. The Nvidia rally fueling the S&P 500 and Dow Jones to new heights on Thursday, and investors are digesting the latest commentary from 5 different Federal Reserve policymakers warning against cutting U.S. interest rates too soon. There you're taking a look at the futures here on your screen. We are up across the board as we're getting closer to the start of today's trading activity. But my goodness, yesterday, everybody and their mother wanted to say something. You had Philip Jefferson speaking, the Fed vice chair. You had Philadelphia Fed President Patrick Harker speaking, Fed Governor Lisa Cook, Minneapolis Fed President. The list goes on, Christopher Waller as well. And so all of them are going to be continuing to get even more reads of this consumer right now on the backdrop of a continued to be hotter than expected employment situation as of right now. Next week, we're going to get a consumer confidence print. We'll see exactly where things really pace out there. And then also the all-important Fed gauge PCE.
Yeah, Brad, there's a lot on tap that the Fed officials, investors are going to be closely scrutinizing here just in terms of what this means for a potential rate cut and the timing of that. But really what we heard from Fed officials this week reaffirms the minutes that we got from last month's meeting, just in terms of the fact that there is some risk here, some caution in cutting rates too early because of the risk that they think that that could potentially pose to the market here. And what I mean by that is the fact that we could potentially see inflation pick up once again rather quickly if the Fed acts a bit too soon. So right now it seems like consensus, at least from the policymakers, majority of the policymakers that we heard from this week, is that they are stressing caution. They're saying it makes sense right now to be patient. Despite that, and you would maybe initially think that the market would be under more pressure than it is, but it seems like investors are really brushing that aside for now and instead focusing on Nvidia. That has been the story for the markets this week, really the story for the markets over the last year. And it's interesting when you take a look at the outperformance of Nvidia. And I'm not just talking about the outperformance of Nvidia, comparing that to the S&P 500, but really the outperformance of Nvidia even to the rest of the Mag 7 stocks. Nvidia up nearly 60% since the start of the year, comparing that to the Mag 7's outperformance of just 12%, 11.5% to be exact, and the S&P's gain there of nearly 7%. So Nvidia really the outperformer so far this year. They've been the outperformer now for over a year. Whether or not that is going to slow down just a bit is what the street is debating at this point.
Jensen's making, or at least posting, photos of himself in his kitchen with chips. So I just imagine, I'm just putting some inference together, 2 and 2, perhaps that's what he's doing in the kitchen. He's cooking up even more chips there. So the overflow really, it's everywhere you look for Jensen.
And investors are loving it, and they're buying Nvidia. You can clearly see in the stock price reaction to those earnings reports out earlier this week. All right, let's talk about the other big headline that we are watching, and that is a big test for the IPO market. Reddit officially filing to go public on the New York Stock Exchange. Now, it is the first big tech IPO of the year. Sources telling Yahoo Finance's Brian Sozzi that the public debut will likely come in late March. This will be the largest social media company to go public since Pinterest back in 2019. Clearly, this is a massive test, not only for, obviously, very specifically, the tech sector in terms of maybe some of those IPOs that we could be getting later on this year, but more broadly speaking for the broader market here, because we know the IPO market has been lackluster, to say the least. There was some optimism at the end of last year that maybe some of the larger IPOs, ARM being one of them, would prompt others to come off the sideline. That, in fact, did not happen. So now that we have this filing here from Reddit, there is some optimism about what this first major tech listing of the year, how big of a boost that could potentially be here to the IPO market and the broader market in general.
Yeah, and you're taking a look at that trend line. I didn't even know if this chart was going to make it into the show. I'm glad it did. Can we toss it back up here? Because it's so important that it comes from the folks over at Renaissance Capital, gives you a good picture of, for these past 2 years, where we've had to bounce off of, and that bottom in 2022. 2023, it was something, but it wasn't anything even near the scale of 2016 for that matter. And so now what we're going to be watching for very closely is which of these is the company that really elicits, or in this market at least, where you're continuing to see things continue to go up on any type of AI trading frenzy that is really being a boost, or at least the focal point for so many investors out there, and a rising tide more broadly. Does that just make it enough of a good environment for some of these companies to say, okay, we're past some of the volatility that would really make us a little bit more wary to enter into the markets? Companies think about that. They think about exactly what the trends are in their own industry as well. And you think about the social media landscape right now. There is a big changeover, a shift in where people are gravitating towards spending more and more of their time. And I think Reddit has done a good job of making sure that they retain a lot of those users. There's one particular term that people are going to hear once this company starts reporting earnings time after time after time again, and it's the daily active users, but it's a qualified user based on or daily unique user, unique active user, something like that. I know I butchered that, but anyway, it's a new one for me too. As we're continuing to look across, there it is, the daily active uniques. This is a person that comes onto the site that is at least loading up the website or engaging with the platform in some form or another here. Larger question of how they continue to monetize that as well.
Yeah, exactly. And two other things to point out here within this S1 filing that took some people by surprise. We're going to talk about a little bit more later here, touting AI as really a growth area. And to expand on that even further, Sam Altman being a very large stakeholder in the company. We knew his involvement, but exactly the size of the stake that he held in Reddit coming as a surprise to many on Wall Street. And then, the other thing that struck me was the fact that Reddit here seems to be leaning into its roots. And I say that because they're reserving stock to sell to its loyal users in its IPO. And they're going even further than that, setting aside some shares to sell to individual investors. They're doing that through brokerages such as Fidelity, SoFi, and Robinhood. So really playing into the base here at Reddit, which is something that also stuck out to me within this S1 filing.
That's right. All right. Decacorn making its way to the public markets. We'll see exactly when they do go. Brian Sozzi saying March, according to his sources here. A big stock to watch today as well, the Warner Brothers Discovery missing expectations on the top and bottom line in its fourth quarter. The media company is seeing its studios, network, and advertising revenue all fall as the effects of the Hollywood strikes lingered into the end of the year. There was one silver lining for the company, though. Streaming service Max ended 2023 profitable for the first time. Let's get to Madison Mills, who's on the floor of the New York Stock Exchange with more on this. Hey, Maddie.
Hey, Brad. So what's really interesting to me about this earnings print from a details perspective is that not only was the results not what the street was looking for, obviously this name is down over 10% in the pre-market trade, but also they changed up what they reported. I want to pull this up so that I get it right. The full year EBITDA and the free cash flow guidance was not provided here. That's an indication to me of knowledge that things are not necessarily going to get better. The CEO did say that they are anticipating more entertainment and property and products coming up, and that would particularly help them in international markets. Sometimes that's what a CEO says when they don't have a lot of other growth to point to. But given all of the downward trends from those Hollywood actors and writers strikes, that could lead to more growth for them moving forward because they'll have the staffing needed to up the revenue for those studios. But that studio revenue dropping 17% in the quarter. You mentioned, Brad, though, that the streaming service Max did end 2023 with profitability for the first time. That's the first major streaming service to do that. So that is a boon against the likes of Disney, Peacock, some of those other competitors in the space, but not enough to lift this stock in the pre-market trade.
All right, Madison Mills, thanks so much. We'll check in with you in just a few minutes as we get a bit closer to the opening bell. All right, well, a historic mission, Intuitive Machines becoming the first private firm to successfully land a spacecraft on the moon, touching down Thursday night at 6:24 p.m. Eastern Time. Now, shares of Intuitive Machines is shooting up as a result of this. You're seeing that optimism reflected in the share price this morning, up more than 30%, I should say. We have video of the station when the lander first touched down. Lots of excitement. Let's take a listen.
We can confirm, without a doubt, is our equipment is on the surface of the moon, and we are transmitting. So, congratulations, IM team. We'll see how much more we can get from that.
Fujita, Kiko, talk to us just about obviously making history here, but the fact that this is being done by a privately owned spacecraft, that is what is a touchdown on the moon last night.
Yeah, Shauna, I mean, this really does point to a fundamental change in the way the space program is now being carried out, at least here in the U.S. You talked about a historic moment here, the first commercial lunar landing, but also the first time the U.S. has had a presence on the moon since 1972. That's when the Apollo mission was closed out here. And when you think about this, this was the fourth try for a commercial company. Now, some comparisons here between what happened back during the Apollo mission and then what's happening today. Back then, it was NASA really funding these big missions here. This time, it is about the commercial side of things here, really leaning in on what the mission is going to be. Now, let's talk about the path it took to get here, because remember, just last month, it was Astrobotic, a Pittsburgh-based company that attempted to make that first lunar landing by a commercial company. That didn't necessarily pan out. Before that, it was Japan's iSpace last year getting really close to the lunar landing before things did not work out. And then back in 2019, you had a privately funded lander from Israel crash on its route to the moon. Now, in all, NASA has awarded $2.6 billion to 14 different American companies. You can expect more of these missions to come here, but NASA really leaning in on the private sector here to establish what they see as a low cost, and we're talking relative terms here because it's not necessarily a low cost, but lower cost transportation system that would allow them to take research up to the moon. Long term, this is about establishing a more permanent presence on the moon. Remember, you've got that Artemis mission scheduled for 2025 in terms of the first crewed mission heading over to the moon, and then another mission back in 2026 as well. So you've got a really long pipeline here, but really, guys, it's important to think about why this is all playing out. You've got SpaceX sending this lunar this specific lander from Intuitive Machines. Before that, it was ULA, this joint venture between Boeing and Lockheed Martin. So really the private sector leading the way here on these lunar missions.
Certainly. All right, Akiko, thanks so much for breaking that down for us. We got to take a quick break, but coming up next, we'll bring you the latest developments on AT&T's network outage and what it could mean for investors after the break.
Let's get to some trending tickers here on Yahoo Finance. Block, or Square as you may know them, delivering a surprise profit in the fourth quarter, and shares are surging this morning. The company also raised its full-year profit guidance by more than $200 million. Block's moves to slim down operations in recent months might just be paying off. Jack Dorsey touting that the company is under the 12,000 employee cap. All right. In the words of Tina Marie, we're talking a little Square biz to you, baby. One of the huge things that True is pointing out here, the Cash App model visibility, is something that they are optimistic about. As this company for Square, or Block, they had talked about getting back to the rule of 40. And for those who are trying to figure out what the heck are they saying on this call about the rule of 40, it's basically saying that a software company's combined revenue growth rate plus the profit margin should equal or exceed 40%. This is something that you see commonly within a lot of software as a service companies as well. So Block being very vocal about that. JP Morgan also giving them a little bit of a nod as well on the go-to-market and pricing strategies within Square with the new pay-as-you-go model as well.
Yeah, certainly a lot of the excitement surrounding Cash App right now. The numbers that Block posted there, ending the year 56 million monthly transacting actives there for Cash App, and going a bit deeper, reported 1.18 billion in gross profit, 25% increase year over year. And Brad, you mentioned some of the street's reaction. What stuck out to me was a note here from Mizuho saying that they believe that the high teens gross profit growth in 2024 is now conceivable, hence meaning that the 15% of from the initial guide might be a bit conservative. So we're seeing a lot of that excitement play out in the stock here this morning, with shares up just about 18% in the pre-market. All right, let's get to AT&T issuing a statement saying that the widespread outage that took hours to resolve yesterday was caused by a software update and that it was not a cyber attack. Now, the company explaining that the disruption was caused by an error that happened when it was expanding its network. The FBI and Department of Homeland Security are investigating the AT&T outage, which affected more than 1.7 million customers. Certainly tens of thousands of customers reported outages throughout the day yesterday. Lots of speculation about exactly what was the cause of it. It seems like, obviously, AT&T clearing up any uncertainty there, saying the cyber attack was not responsible for this wireless outage that was actually due to a software issue, but still clearly affecting many of its users. I think what investors are asking here this morning, Brad, is what this means to the bottom line. If there's any real impact, whether or not that's on a quarterly basis in the long term, not too likely, but you would think there is some backlash from some of their users after what played out yesterday.
Yeah, certainly hit the stock price. We saw that react as we were kind of tracking this throughout the day. You got to wonder, especially with outages like this, if some of the investments that we're hearing about from these companies, and we spoke with John Stankey, the AT&T CEO, just last Friday about some of those investments that they're making specifically in AI and what AI can do for making it easier to find out where the sources of these outages are and remediating them that much quicker. I'm not sure or certain if it will definitively, but that is at least something that the companies are putting on the docket for their spending to shore up the network and the service level agreements that they do have with all their customers. But no doubt this was one of the top trending just business stories yesterday, and frustrations that we had seen from some disgruntled customers out there that weren't able to download that cat video.
Yes, there's a lot of people who are upset, and many people here in our newsroom who did not have service, at least for the first part of yesterday. All right, well, Warner Brothers Discovery shares are falling after missing expectations on both the top and bottom line in the fourth quarter. Now, the media company is seeing its studios network and advertising revenue fall as the effects of the Hollywood strikes lingered into the end of the year. Let's talk about it with Rich Greenfield. He's LightShed Partners media and technology analyst. Rich, it's great to see you here. So let's talk about these results and what it means for the broader streaming landscape. The thing that stuck out to me was the fact that they are making some progress when it comes to the streaming business and what they are seeing there, specifically what they're seeing from Max. I guess put that in perspective for us, just in terms of how much more optimistic, maybe are you more optimistic about what the rest of the year will potentially look like as a result of that?
Look, I think investors are panicking right now. It's when you see the stock down 10% or so pre-market. I think the fear is that the company was unwilling to give any form of guidance. They've been pretty vocal in the past about talking about 2024, even going back to when they closed this transaction. And while numbers have certainly stepped down over the course of the last several years numerous times, they've always been pretty forthcoming with, what the year ahead looks like. And this was the first time that they basically said that they just can't do that. And I think the sort of fear that is sitting with investors right now is the concern that numbers are coming down and that, sort of the inability to guide is sort of, another way of saying we're going to be lower than we previously anticipated. So they're doing a great job of cost cutting. There's no doubt that David Zaslav and Gunnar Wiedenfeld, their CFO, they've done a great job of living up to the free cash flow numbers that they promised Wall Street. The challenge is they haven't been able to grow the business. And I think what you're really seeing from investors is it's hard to pay meaningfully for a company if they do not believe that there is future revenue and earnings growth. And so you can cut and certainly generate cash in the short term, but cost cutting is not a long-term strategy. And I think that's sort of the reaction you're seeing in the stock today.
So then, Rich, what needs to change? Because yes, like you said, free cash flow was one of the highlights in this quarter at $3.3 billion, above what the street was looking for. Some speculating whether or not that trend can continue while they are paying down debt. But I guess what else do you think is necessary in order to win the confidence of investors, which clearly many don't have right now?
Look, we think they have to shut down the Max strategy. I think we've been pretty vocal, very vocal, that Max is a flawed strategy. You already see them starting to license a large part of their content out to Netflix. Look at things like Ballers on Netflix now, and like all of the sort of 6 Feet Unders, those key titles now are showing up on Netflix. Like, I think we're at the point now where HBO is an incredible business. There is it is a one-of-a-kind global iconic brand. That said, I think the idea of trying to build something far bigger just isn't working. And I think just from a, was there a way to do it? I'm sure. I think given where the sort of legacy businesses at Warner Brothers Discovery are, meaning the challenges facing linear TV, whether we're talking, Discovery Channel, whether we're talking TBS and TNT, like those businesses are facing tremendous industry disruption, headwinds. And I think given those headwinds, you have to take a different strategy in streaming. And I think, essentially scaling back, becoming more of just HBO, really focusing specifically on the US, abandoning sort of global desires, and really focusing on being an arms dealer of content to third parties and stopping this trying to be a sort of a broader streaming service. I think it's inevitable. I don't think management is there yet, in terms of like what they want to do. But I think over the course of 2024, we think they're going to get there, and you'll see a tremendous shift in strategy.
Wow. Rich with the Ballers mention. I'm not sure who told you my viewing history, but kudos to them for getting that data. Rich, while we have you here, when we think about sports and this tie-up that is attempted, does the street do you believe that there's a high probability that this will actually be consummated between Warner Brothers Discovery, Disney, Fox?
It's a great question. I don't know. I mean, look, everyone has always, everyone's been preaching for a long time from a consumer standpoint, more flexibility, right? Like, you don't want this channel, you want that channel, you don't want to have to pay for everything. So the idea of smaller bundles is not new. It's never been available. And so do I like the idea of programmers offering smaller bundles? Absolutely. Is this smaller bundle with sort of a slice of sports, is it really that compelling? Hard to know. I mean, I worry from a cord cutting standpoint that there's people with YouTube TV or Hulu Live or Comcast who look at this and go, God, I need to have Peacock for WWE, or I need to have Paramount Plus for Champions League. Well, I already have those two. Well, if I can get this skinnier bundle, I'll drop down, save myself $20, $30 a month. So I worry that there's sort of a cord shaving element to this that isn't so great for companies like WBD. So I'm surprised in many ways that they're part of this. But look, I think from a consumer standpoint, offering more options, for all the viewers that are watching this right now, having more options is something people have wanted for a long time. So I think it's very consumer friendly. I'm just not sure it's great for the health of the industry overall. And it'll be interesting to see whether we see other smaller bundles, because I would assume every distributor is now going to be putting their hand up going, hey, I'd like to do this too. And I want to offer Fox Sports without Fox News. I want to offer TBS and TNT without CNN.
Right.
That's a Pandora's box.
Hey, Rich, just lastly, while we have you, what's the core way that this company can go about extracting more value from its current subscribers?
Look, I think the reality is people are going to be subscribed because they're passionate about the HBO content. And I think, sort of focusing on the pieces of content, you've seen HBO, I'm sure, for 20, 30 years. There's this type of programming that it's known for. And I think sort of centering on, a major piece of content every quarter is probably the future and is probably enough. It may not be as big of a business globally, but it'll be a much, much more profitable business. I think what people are forgetting today is HBO before Max was a $2.5 billion EBITDA business. World has changed. Maybe it's only a $2 billion business, but relative to sort of Max at break even, there's still a long way to go if you simplified the strategy.
Rich, speaking of strategy, you mentioned that bundling makes sense. You are a fan of it more broadly speaking. When it comes to maybe future consolidation, obviously long rumors of that, whether or not that's going to really come to fruition this year. How do you see that playing out and the impact that it's going to have more broadly speaking, obviously not only in traditional TV, but really the leadership within the streaming space?
We believe that all of this is great for reporters to, you've seen lots of news stories and lots of headlines, and it's fun to talk about consolidation, but I think in the midst of what is going to be a very spicy, I don't know what the right word is, but let's just say spicy presidential election with a relatively hostile antitrust administration today, and with a potential administration, if you switch to, let's just say Trump, who has been pretty hostile towards legacy media companies. I think the idea of any form of M&A this year is essentially DOA. Like, I just don't think it's going to happen. I think you keep hearing lots about it. People talking about Paramount, people talking about WBD. I honestly just don't think M&A is going to happen this year. And all of these companies are not going to have M&A as a lifeline. They're going to have to figure out how they survive without M&A.
All right. Rich, always a pleasure getting your insights here. I guess we'll all just have to wait for 2025 for White Lotus to come back on HBO Max. Rich, appreciate the time as always. Rich Greenfield, Lightshed Partners. Appreciate it. All right, guys, and we've got just about 90 seconds until the opening bell here. We're taking a quick look at some of the major averages. You've got them in the bottom corner of your screen and now blown up in big numbers here on your screen as we're just seconds away. We've got green across the screen. The Dow futures, the S&P 500, and the Nasdaq futures all pointing positive on a week that has really been fueled by so much fanfare around this Nvidia earnings report, as well as a host of others here. But that largely driving much of those gains that we saw yesterday, and a record market cap additive type of day for Nvidia as well.
Yeah, it certainly was a record-setting intraday move here that you can see just in terms of the market cap, single-day gains, I should say, for the market cap for Nvidia. $277 billion was a one-day boost to its market cap yesterday. The biggest single-session increase in value ever. It looks like we might. When we start the trading day, we might start at just over $2 trillion in market value. That, of course, is the level everyone on the street, or many people on the street, are closely watching here. But really, more broadly speaking, for the market, you're looking at the major averages not too far from the flat line, as we do take a bit of a break here from yesterday's big move to the upside.
Look at the Harlem Globetrotters ringing the opening bell on Wall Street, up there at the NYSE. Oh, yeah, that's something that I could actually never get down. I played basketball growing up. I could never spin the ball on my finger.
Me neither.
Why?
It's hard.
Why? Jesus, why? Anyway, Lotus ringing the opening bell at the Nasdaq. You got a lot of funfetti. We're going to speak with them a little bit later on. Oh, there's the car that we're going to be discussing as well. Very spicy EV that they've got in there in Midtown Manhattan. All right, we've got some team coverage of the biggest market moves following the opening bell on Wall Street. Yahoo Finance's Madison Mills is on the floor of the New York Stock Exchange, and Jared Blickery is on standby at the Interactive. Nasdaq and the S&P 500 both hitting their best days of the year this week. Maddie, what are you hearing around the exchange?
Well, it's a very happy Friday here as the S&P 500 and the Nasdaq are coming off of a one-year high. Of course, fueled by that stock we never really talk about. It's called Nvidia. You might have heard of it, but it's not just about the Nvidia moves, because that stock was so powerful, as you guys mentioned, adding the likes of a Disney, a Netflix to its market cap in just 24 hours. That stock is pushing a broadening, and we're seeing an upward movement in the equal weighted S&P 500 as well. So that could be an indication that some of those concerns about market concentration are starting to unwind. And we're not just seeing this playing out here in the US. We're seeing this globally. The CSI 300, which is the stock index in China, up over the past 5 days after a lot of volatility there. We've been talking about the Nikkei index out of Japan hitting all-time highs after a 34-year deflationary period in that region. And this is coming as we've been talking about recessionary trends in countries like Germany, in the UK, in Japan. And we're still seeing this one stock pushing markets higher across all of those areas of the globe. That global stock market rally driven by Nvidia. The question for me is what's going to happen with the unwinding of market pricing for Fed cuts? Is Nvidia going to be able to continue to push this market forward despite those rate cut hopes declining?
All right, Maddie, thank you so much. We've got even more coverage here with Jared Blickery standing by at the home base with the Interactive pulled up behind him. Hey, Jared.
Hey, Brad, a lot of green, not necessarily, well, look at that. The small caps, Russell 2000, flirting with the unchanged right now. The other markets, Nasdaq up about 0.5%, and the Dow and S&P 500 up a little bit less than that. I want to focus on yesterday real quickly. We had 46 record highs in the S&P 500, and that's the most in a long time. And importantly, you break that down by sector, 15 of those were in industrials. That's a number one. Number two, we have financials with 12 record highs. And only in third place do we have tech with 8 record highs. So something to think about there. Also, is the last time the Nasdaq 100 closed at a record high while being up 3% since March of 2000, and a pretty ominous date. But I think that stat is getting a little bit too much play just based on, I think contextually, you have to realize that happened quite a bit on the run up to the top of the tech bubble. All right, just taking a look at the sector action today, we have tech followed by financials. Both of those outperforming. Financials, one of the top sectors in this rally. To the downside, we got energy trading down 1%, staples and consumer discretionary just barely in the red. And here's a 5-day look at the sector action. More evidence that the rally is broad-based here. Materials up 2%, then we have staples, that's a Walmart play, and then we have tech. So all three of those outperforming, and only energy, real estate, and communication services trading to the downside for the week, but just barely so. And let me just leave you with the Nasdaq 100. I'm going to show the market caps here real quickly. Nvidia, look at that, 2.037 trillion, and that is on a price of $814 up. Let's see, over the last year, 244%. So add Nvidia to the $2 trillion club, guys.
All right, Jared, thanks so much. Really teeing up today's trading activity, plus those record highs from yesterday. Really astounding here. Jared, appreciate the breakdown there. All right, everyone, we've got much more on the other side of this short break. Don't go anywhere. You're watching Yahoo Finance Live.
The S&P 500 pushing above 5,100 here at the open as investors look to end the week with gains. Now, Nvidia really fueling this week's rally, crossing the $2 trillion valuation mark here at the open. Now, could the massive rally that we see mostly concentrated in a handful of tech names, could it eventually lead to some irrational exuberance, or has it already? Here to break it all down, I want to bring in Brad McMillan. He's Commonwealth Financial Network Chief Investment Officer. Brad, it's good to see you here. So how should investors be thinking about the massive gains that we've seen in tech, and largely on the back of some of this excitement surrounding Nvidia?
Well, when you look at the AI boom, I mean, you really are talking about, to some extent, rational exuberance. This is going to change the world. It is changing the world. But at the same time, one of the comparisons you mentioned earlier is like March of 2000. We can change the world and still have things being overpriced. So on the one hand, I'm cautious about what we're seeing in kind of the Magnificent Seven. But what someone said earlier was start to see the equal weighted stock market come back. So when you look at that, you say, okay, there's still some room in the broader market. And there, I think we're starting to see some rational exuberance as far as the broader market goes. And that's good news going forward.
Brad, what could throw a dent in some of that exuberance?
The one thing that I've been saying this whole time is we're not going to have a recession. We're going to see continued growth as long as the jobs market continues to do well. You know, and that's something we keep talking about, risks and recession and this and that and the other. As long as people are being hired, as long as people feel good, they're going to spend. And that's over 70% of the economy. And we actually see that accelerating. For a lot of good demographic reasons, I don't see that changing. So actually, I'm pretty optimistic about the economy and the country as a whole going forward.
Brett, how are you looking at the chance that the Fed could keep the rates higher for longer? We saw, obviously, traders maybe paring back their estimates in terms of the timing of that first rate cut. Is there too much optimism to some extent that's already been priced in terms of the timing of the rate cut?
I think there's absolutely too much optimism because I don't see the Fed cutting rates anytime soon, probably not this year. I think we've been asking the wrong question. Everyone's saying, when is the Fed going to cut? My question is, why would the Fed cut? Inflation is still too high. Employment is still great. They have no reason to cut, and I don't think they're going to.
And so if the Fed does not cut, and if higher for longer is just what we need to get used to, is there a significant repositioning of portfolios that you're expecting?
I'm not so sure about that, because what we've seen with the 10-year, which is really the relevant interest rate as far as stock valuation goes, it's come up and we've still seen the market rally. I mean, what we tend to forget after the past decade or so is the economy and the market can actually do very, very well with rates about where they are right now. So you look at this, I think the market is normalizing. I think that's exactly what the Fed wants to see. And we don't need rate cuts for the market to keep moving higher.
Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thanks so much for taking the time here with us this morning.
Thanks for having me.
Certainly. Coming up, all 7 members of the Magnificent Seven have reported earnings this season. But who came out on top? We'll break it down next.
All 7 members of the Magnificent Seven, Nvidia, Microsoft, Meta, Alphabet, Tesla, Apple, and Amazon, have reported their quarterly results. Now, these stocks are responsible for the bulk of the recent market rally. Get this, accounting for 75% of the S&P 500 gains this year. But we're going to take a step back to discuss which Mag 7 number is the best and worst position moving forward. Let's start with investor reaction to the earnings. Yahoo Finance's Jared Blickery is over at the big board with a closer look at this, Jared.
Thank you, Shauna. I think this chart says it all. These are the top one-day market cap gains, and this got erased. Yesterday, Nvidia took the #1 slot for Meta, $277 billion. That was the point move yesterday. Just crossed the $2 trillion market cap valuation threshold only this morning, trading something like $815 per share. And #2 now is Meta. Only, less than a month ago on Groundhog's Day, Meta surprised investors and made a 20% gain. And in fact, if we take a look at all of the gains here, we have quite a bit dispersion of results. Meta, the best off, up 20%, followed by Nvidia, 16%. That was yesterday. Then Amazon, 8%. And then Apple, just barely in the red. Microsoft and Alphabet also trading down. And Tesla was the worst off, down 12%. But when we take a look at the market cap reactions, we got a little bit of a different pecking order here. Alphabet, the second worst off in percent return, is actually the worst in terms of market cap. That traded down $153 billion the day after. Then we got Microsoft, Tesla, Apple, all trading a little bit negative. But then Amazon up $139 billion. That doesn't even make the top 5 anymore. And then we have the two we were already talking about, Meta and Nvidia, with that $277 billion gain only yesterday. And just taking a look at some of the intraday price reactions, I thought it was pretty interesting. Here is Apple. This is the morning and the day after that post-bell announcement. And you can see we actually opened up lower than the prior day. And at the lows, Apple was down 4%, but managed to pare those gains considerably and only ended up a fractional percent down. Also taking a look at Tesla, you can see that was a pretty bad report for investors. And let me just get that out of the way. We can see it traded down and closed near the lows. But if I take a look at a 6-month view there, potentially, we don't really have the support I was looking for. I think I'm going to have to go on to Meta here. Now, this is a blowout report. We had Meta up 20% and to record highs. I just got to show you the 3-year chart. After having been suffering a huge decline here from over high $300 to a share to below $150, we are back up to $493, and those are Nvidia numbers right there. At least on its heels, maybe.
Yeah, those are metaverse-like numbers. Jared,
I like
Jared,
that.
Thanks so much for taking the time, teeing up this conversation. We're going to continue this around big tech and specifically the Magnificent Seven, all finished earnings for the quarter. But we want to cut through the noise, break down which stock is best and worst positioned coming out of these earnings reports based on the fundamentals. So here with more, we've got Nancy Tengler, who is the CEO and CIO of Laffer Tengler Investments. Also here, we've got Stephen Glass, Pellet Funds Management Managing Director and Investment Analyst. Great to have you both here with us today. Nancy, I want to begin with you because you are looking specifically at one of the best positioned companies. We'll start with the good, then we'll get to the bad. Best position here, Amazon. Make the case for why Amazon, even up against Meta and Nvidia, is the outperformer.
Well, it's a game of relative performance from here. I think, clearly Nvidia is the winner and will continue to win, I believe. But Amazon has yet to hit to retest its highs, and it's a company that has, done improved efficiency, growing the advertising business. Cloud came in better than expected. And you have a CEO who is committed to taking the company to the next sort of level. And so we think from here, you'll get really solid performance out of Amazon. And so we've moved it into our 12 best ideas portfolio and continue to hold it across our large cap equity strategies.
Steve, I'm going to ask the same question to you in terms of who is best positioned. It looks like you think Nvidia is. What do you see as the upside there, just in terms of how much more gain is still in play?
Well, it's very difficult to actually have to force one to use their imagination. But the fact of the matter is, this is a company on a 2% free cash flow yield, and it is and it's only expected to grow 20% in 2015. So really, its valuation fundamentals remain very strong, and it can continue growing here. I mean, Jensen Huang was commented on the size of the opportunity. It's bigger than everyone expected. It's a whole new industry, and it keeps on surprising. So in actual fact, on raw valuation figures, it's actually one of the better positions of the Magnificent Seven.
All right, I want to get to one that, Nancy, you believe is worst position, and Stephen, going to bring you in on this as well, because I know you've got some commentary on their positioning, but it's Google, it's Alphabet. Nancy, why is this the worst position to you?
Company has, Brett, that's a great question, Brad, because it should, by its recent performance, at least be teed up to outperform going forward. But they keep stumbling. So this latest issue with the images on Gemini is the second hiccup since they've announced generative AI. They are behind, at least in the intellectual capturing war with Microsoft. And so I think you want to, be dubious. Use weakness maybe if you don't own the position to add to it or initiate it. But we are holding firm and not adding to our holdings because we think it's going to be a while before the company gets past these negative issues.
Stephen, two names that you see as worst position are Tesla and Apple. Tesla, I think everyone can pretty much wrap their heads around just the fact that we've seen declining sales, the fact that margins have been under pressure. But why don't you see Apple turning it around anytime soon?
Well, the fact is that's a fully penetrated market. I mean, obviously, we're dependent on services now, and they are doing very well in services, but they have to justify that market cap. They don't seem to have a large pipeline of new products coming through. And where Pella's not suggesting for a moment that Apple's a bad business, it's just not growing and it does not justify its valuation given its growth profile. One just has to accept that if they invest in Apple, they're going to get based on the current valuation and growth profile, quite meager returns.
What's going to unlock the next super cycle? Just to follow up on that, Stephen.
Super cycle for which company?
For Apple. We often talk about an iPhone super cycle, whether or not generative AI as part of the smartphone or the handset is actually going to propel a wave of new people to go trade in, trade up, and get whatever the new iPhone is. What from your perspective, can drive that?
That's unlikely. That's unlikely because actually at the moment the AI is happening in the cloud rather than at the edge. So it's not really a personal device driven market. And even if that was to happen, I mean, it's very well penetrated. So we're just swapping a current user for a new user. So then you've got to ask yourself, okay, can they expand their margins on the iPhone? Well, no. Can they grow more sales? Potentially, but then they've got the problems on the App Store. They really do, in our view, need to come out with a new product to justify their current valuation. They need some new growth vector. And we don't think it's going to be the headset. So it's based on what we can see right now. We can't see where that new growth vector is going to come from. And in actual fact, we actually think the App Store is at threat from we see the regulation around the world. We see it in Europe. We've seen some in the US. And maybe it'll be more difficult for them to take a 30% cut on all app sales going forward.
Nancy, one of the names that we have not mentioned yet is Meta. And I bring that up given the outperformance that we saw last year, given the fact that the stock is up just about nearly 190% over the past year. They declared their first dividend last quarter on the earnings report. Obviously, lots of excitement there. Why isn't that one of your top names?
Yeah, well, we did own it, Shauna. We owned it for many years, and we got out kind of in the high 300s. And then, we missed this last run. But we instead owned a name like Spotify in its place, and that's done extremely well also. I love the dividend. I think that there is an opportunity for Google potentially to announce a dividend. I mean, they certainly have enough free cash flow. But I think Meta, for me, at this point, I'd rather jump into Nvidia than into Meta, because I think the model is not nearly as robust as Nvidia's model is. And I would just point out that I think one of the things that's going to put a floor under all these stocks are share buybacks. The Magnificent Seven have announced about $190 billion in share buybacks. As these stocks sell off, that the companies are going to step in and put a floor under it for investors. So I think you can't go wrong owning any of them, in my view. But I think our favorite right at this point is Amazon.
All right, Nancy and Stephen, great to get your insight here, especially on names that we know so many of our viewers want to own, would like to own, or are closely following here when it comes to some of the trends that we're seeing in the broader market. Thanks so much. Have a great weekend. Well, coming up, Reddit filing for its IPO, and a big name is set to make millions, at least from its stock exchange debut. The man right there on your screen, Sam Altman. We'll talk about it when we come back.
OpenAI's frontman, Sam Altman, stands to benefit from the initial public offering of a household-known decacorn as the third largest stakeholder of Reddit. He controls 8.7% of the company's stock. Altman also served on the company's board from 2015 to 2022. I did not know that he served even as CEO of Reddit for 8 days. So hold that, Scaramucci.
Yeah, I was like, well, if you blinked, you might have missed it. It was a very short time there that he did hold that CEO position. But really what is interesting about this, we knew his involvement within the company. We didn't know the scale in terms of the number of shares that he did own. So the fact that he is the third largest shareholder really puts that in perspective here for us. And we're bringing that up because one of the areas that was touted here within this filing was AI. In S1 filing, it's AI and some of their ambitions there, what they are seeing play out. We know they have a deeper partnership right now with Google. Exactly what that will lead to in the long run, many people are speculating about right now. But in terms of what has been released, it's going to allow Reddit to integrate new AI-powered capabilities onto the platform. Sam Altman being amongst the largest stakeholder here within the company. Clearly, you would think AI is going to remain or be a focal point in terms of future growth here for Reddit in the coming years.
Yeah, absolutely. And for Reddit, what we've already seen them be able to do, and we talk about the retention of users, we talk about making sure that this platform does ultimately get past some of its own risk factors, which is, and it comes back to the users and the content itself. I think for generative AI and the ability for AI specifically to really track across some of the other social media platforms when content that violates terms or the agreement, the usage agreement gets violated. That's where AI already plays a role in some social media. And so for Reddit, it'll be interesting to see where they continue to lean on Sam Altman and OpenAI and some of the ingenuity that they've and innovation that they've been able to put forward with ChatGPT and infuse that even further into the platform as well.
Yeah, it's going to be interesting also just how this IPO is received. We talked earlier in the show about what this would mean to the broader market, but one thing that we didn't really dive into is just the fact that it's challenged here in terms of the lack of profitability. And when we see what has been a focal point here for investors over the last several months, it has been proven profitability, something that Reddit has not exactly shown as of yet. And on the sales side, most of the revenue still being generated from advertising. So I think there are still question marks in terms of what that future potential profitability could look like and exactly how long it would take Reddit to possibly get there. All right, well, coming up, we will talk much more about today's market action, the gains that we are seeing here at the open, and the impact. Some of the recent comments from Fed officials this week in terms of the timing of a first rate cut. We'll be right back.
Welcome back to Yahoo Finance on this Friday. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. The S&P 500 hitting a fresh record, climbing above 5,100 as Wall Street looks to end this Friday on a happy note.
All right, let's get to some of our individual movers. We are watching shares of entertainment platform Live Nation is jumping this morning after another record quarter. It saw revenue surging from the quarter, up 36% from 2022, pointing to record attendance, ticket sales, and sponsorships. Now, consumer demand for live concerts was especially high. Revenue from that division was up 39% from a year ago.
And Booking Holdings shares are in the red despite reporting a beat on both the top and bottom line in the fourth quarter. Gross travel bookings also beating expectations. The company announcing it would initiate a quarterly cash dividend of $8.75 per share. And Barclays getting bullish on DraftKings, upgrading the stock to overweight from equal weight and upping the price target by $9 to $50. The analyst Brant Montour saying that sports betting has staying power in the everyday life of American sports viewers, and the digital gaming market should see notable growth ahead.
All right, and one more trending ticker that we are watching, it's Carvana. Shares surging today. Lots of excitement surrounding this latest result. You can see it up just about 42%, reporting its first ever annual profit. Now, the rental car company also posting a fourth quarter loss that narrowed from a year earlier. Now, this coming after Carvana issued a turnaround plan last summer that included a deal with bondholders, trimming expenses and clearing some of its inventory. So I guess in terms of shareholders, investors' eyes right now, it's in a better position than it had been in the past, but still a long list of challenges ahead here for this company. It's likely going to continue burning cash this year. It's got a large amount of debt, so that leaves the company really on the hook for those large interest payments. Also, really the need to cut and control their costs. And Jefferies, one of the analysts out this morning, that poured a bit of cold water on some of the excitement or optimism, I should say, saying that yes, the guidance was impressive, but still that long-term visibility remains very low.
Yeah, they are not seeing that visibility that they'd like to into that long-term profitability. They point back to the GPU. Now, if you're thinking of Nvidia, and of course all of the fanfare around this week has been, you wouldn't be wrong to think that it's graphics processing units. It's not. It's the gross profit per unit in this Carvana case here. They believe that GPU, that gross profit per unit in recent quarters, has benefited from transitory tailwinds that may reverse once Carvana returns to more aggressive growth. Now, for where it stands right now, total gross profit per unit, the GPU, of about $5,730. That more than doubled year over year. It was actually about 4% above consensus as well. And they said that that's driven by about 22.5% upside to the retail GPU here. So ultimately, it's going to come back to where more of that visibility starts to exist within that long-term profitability and comes back to the GPU. All right, guys. Well, let's talk a little Fed here on the day. Federal Reserve speakers this week, they were maintaining a cautious approach to cutting interest rates, echoing the minutes released on Wednesday. Now, this comes as a reaction to January data showing inflation stayed unexpectedly high, pushing back hope of that first rate cut to June. So let's bring in Matthew Luzetti, who is the Deutsche Bank Securities Chief U.S. Economist, to discuss more. Matthew, always a great pleasure to get some of your insights here. First and foremost, I mean, we were thinking May, now we're pushed back to June. We actually had Brad McMillan on here with us earlier. He said you might want to take the probability of a cut just off the table this year. What are some of the readings shifting in terms of your stance?
Yeah, we've been expecting that the Fed would cut rates in June, and I think certainly the recent communications that we've gotten from Fed officials, which are right, have leaned hawkish, have supported that. I think when you look at some of the Fed officials, certainly Vice Chair Jefferson yesterday, Governor Waller yesterday evening, they're looking at the data earlier this year, a strong jobs report, very strong jobs report, a big pickup in inflation, a stronger than expected Q4 GDP report. I think they're concluding two things. One, there's no urgency to cut rates. The economy is performing well. Why do they need to ease back on monetary policy restraint given that? And two, there is some more significant uncertainty about whether or not inflation is on a downtrend. We got that strong January inflation report. And so they want to see additional data points really to get confidence that inflation is going back to 2% before they begin to cut rates. We agree. I think that likely happens at the June meeting.
Matt, what did you make of those two reports that we just got? Are you still confident that inflation is cooling despite those blips?
Yeah, I think that there was a number of idiosyncrasies within the data. So owner's equivalent rent within the shelter component was very strong within the January data after showing this clear downtrend. I actually do have decent confidence that that is going to reverse, and over the next year, shelter inflation comes down. We know from all these private sector estimates that they've disinflated very materially, and actually some of those estimates are in deflationary territory. So I think some of that will come down. Other components, portfolio management within the PCE inflation gauge actually tracks the market. So as markets move substantially higher, it leads to inflationary pressures, but that's just a transitory story. So we still do have reasonable confidence that inflation will come down over the course of this year. But I think you do have to acknowledge at the same time, you got a strong print and there's some greater uncertainty around that.
What type of, and when we think about that trend that we're trying to watch so closely to see if and when it's locked in, even if we did see that trend get locked in, how quickly would the Fed feel the propensity to need to cut as long as that trend is remaining kind of in line with moving towards their target?
Yeah, I think they've signaled that from a risk management perspective, they don't want to cut rates too early. They're seeing an economy that is performing well, financial conditions that are quite easy with equity markets at record high levels. So there's nothing really pushing them kind of urgently to move. At the same time, they do believe that policy is restrictive. We do see some of the stresses that may cause either through regional banks or CRE or consumer delinquency rates rising. And so I think from the Fed's perspective, they have what looks like a soft landing in hand, and they are still concerned that if they don't begin to ease policy somewhat, at least over the coming meetings, that they could potentially jeopardize that, and that it transpires into something that's a little bit more adverse, and then perhaps you get a mild recession. And so I think the Fed does see a strong case to cut rates, but clearly at the moment, with a strong economy, there's nothing urgently pushing them in that direction over the next few months.
Matt, even if the economy is able to hold up relatively well, what do you think the impact's going to be on the labor market if we do see the higher for longer interest rate approach take hold?
Yeah, I think you've seen the market reprice tremendously, the Fed. You know, we were pricing not too long ago about 160 basis points of rate cuts. We're now down closer to 75 basis points, which is what the Fed was signaling at the December meeting. And despite that, markets have taken them quite well. Equity markets are at record high levels. Credit spreads are still tight. Volatility is still low. You know, yields have moved higher, but it hasn't really spilled over into broader financial conditions. And so I think that does create uncertainty. You know, even if you see the Fed being more cautious here, as long as the economy looks resilient, as long as the underlying economy and fundamentals look strong, then it's not obvious that pushing out rate cuts has a material negative impact on the labor market.
All right, Matt Lozzetti, always great to get your insight here. Thanks so much for joining us here this morning. Deutsche Bank Securities Chief U.S. Economist. All right, well, housing hurdles aren't going away anytime soon. Home buyers grappling with the low supply that has pushed up prices, making buying a home unaffordable for many Americans. Housing market right now.
The U.S. housing market is facing a trifecta of challenges when it comes to affordability: tight inventory, climbing prices, and elevated mortgage rates. So what does this mean for buyers and sellers? Here are 3 things you need to know about the 2024 housing market. Number 1, inventory. People are staying in their homes longer. Thank you, baby boomers. The lack of homes for sale and high housing costs are just some of the reasons people aren't moving. Sales of previously owned homes hit its worst level in decades last year as elevated rates and rising home prices deadlocked affordability. The demand-supply imbalance will carry into this year. There is a 3.2-month supply of unsold inventory at the current sales pace. For perspective, at least 6 months of inventory is considered a healthy market. Despite the tight inventory in the resale market, the newly built home market remains attractive. New homes accounted for nearly 32% of single-family homes for sale, Redfin reported, marking the highest level of any fourth quarter on record. But inventory is only part of the story. There's also the dilemma with home prices. Number 2, home prices. Buyers beware, but sellers rejoice because home prices have never been higher. The median price for a home is around $361,000, up 5% from the prior year, Redfin reported. The pressure of limited housing supply has kept home prices elevated. Homes were 6.7% less affordable in December on a year-over-year basis, the National Association of Realtors reported. Despite elevated prices, builders were able to take advantage of lean inventories in the resale market and offer buyers incentives, including price cuts. The median sales price of a new home fell 6% from a year ago to $434,000. But it looks like home prices won't be leveling off anytime soon. Data from Wells Fargo projects new home prices to rise 2.2%, while existing homes are estimated to increase 3.1% this year. Number 3, mortgage rates. Another reason for the limited supply of homes has been the lock-in effect. At least 80% of homeowners who hold a mortgage had a rate of 5% or lower nationally in the third quarter of 2023, discouraging homeowners from selling and buying another in today's high interest rate environment. Rates have roughly doubled since the pandemic, thanks in part to the Federal Reserve's fight against inflation. Inflation remains stubborn, leaving rates elevated. Last year, mortgage rates rose above 8% in October, but have now come back down to range around 6%. Data from Freddie Mac shows that the average mortgage rate for a 30-year fixed loan climbed to 6.7% from 6.64% a week prior. Not much reprieve there. By contrast, home builders have been able to win the housing recovery by giving buyers what they want: mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan, making new construction the place for deals in this housing market. Economists expect the housing recovery to stall over the next few months, given that long-term interest rates have jumped back up again this year. However, the hiatus will likely be short-lived. How will this economic picture play out throughout the rest of 2024? Make sure to stay up to date on the latest developments as Yahoo Finance continues breaking down everything you need to know about the housing market this year.
The resilient consumer is one of the big factors that has helped the economy avoid a recession. So far this earnings season, key retailers, though, have cautioned about weakening sales trends, inflation still being a problem, and pickier customers. Well, investors, we are going to get a closer look at some of these spending trends next week with Lowe's, Urban Outfitters, TJX Companies, and Best Buy all scheduled to report. Let's talk about what we could expect with Simeon Siegel. He's BMO Capital Markets Managing Director. Simeon, it's good to see you here. So when we think about the companies that have reported so far, there has been a trend of consumers once again trading down. They are clearly being hit by the fact that inflation has proven to be even stickier than many forecasters had anticipated up until this point. What does that mean for some of these retailers that are set to report next week?
Hey, Shauna, great to see you. By the way, you reminded me how busy and painful next week is going to be. Thank you. So
just a friendly reminder ahead of the weekend.
Right. It's a great Friday reminder. That's great. So I think what is very interesting right now is there's an incredible amount of nuance at the company level. And in theory, that's a very encouraging thing if you're a stock picker. The problem is we can look at the market and we can see what happened yesterday as an example. And there is so much of the stock trading dynamic, which is just market driven right now. And so I'm looking at some of these businesses and saying, you know what, for the first time since the pandemic, companies actually have to execute well. You're watching certain companies drive revenues up, certain ones drive revenues down. You're watching certain companies see material gross margin expansion, others a lot less so. And so that's really comforting. The problem is right now, all my stocks are up. And so when I look across the board, it's going to be very interesting next week seeing what matters, what people want to focus on. And I think that's your question. And so what I'm going to keep an eye on is the fact that so far, my companies on average have seen revenues grow mid-single digits, but they've seen gross margins expand by 200 basis points. There's still this benefit from supply chain. And so this is a very important quality of earnings story to keep in mind.
How would you describe the consumer amid this earnings season as well, Simeon? I mean, when you think about where the consumer is still willing to buy in at full prices versus where they're looking for deals and looking for value hacks.
Yeah, it's such an important question because we're all hearing the consumer. Listen, it sounds pretty scary. So if the question is whether consumer's healthy or not, I don't know. If the question is whether the consumer is spending or not, well, the revenues are saying they are. And so I know there's this perception that because of inflation on staple items, people aren't buying discretionary, but I'm not seeing that in the results. We are seeing revenues grow. And so I think that's this really fascinating conversation as we look. Listen, we'll see TJX give us a very good snapshot on people that are specifically looking for value. But then we'll see Birkenstock, on the other hand, where people are buying, perhaps paying more comfortable spending up. So I think it's much more of a company specific. I think you give a consumer something that they want to spend on and they're willing to spend on it. Whether that's healthy or not, that's a different conversation.
Simeon, what does the promotional environment look like right now in terms of the channel checks that you've been seeing? And do you expect that trend that we did see play out over the holidays, is that something that's going to remain intact in 2024?
Yeah, I think that the holiday trend probably will, because the holiday trend showed certain companies promoting and certain ones not. And I think that's a really interesting example. Like Bath & Body Works is going to report next week. I'm hoping that what they tell us is that they pull back on promotions because they believe that they can drive a full price sell-through. That's a scented candle. It's not a big ticket item, but it's an item where people feel very passionate about and they're willing to spend. It's clearly it's more discretionary than it is staple, although maybe some people would disagree. And so we've definitely been seeing promotions. We've been seeing the companies that need to drive demand resort to pulling that price lever. But we've also been seeing plenty that are not talk about prices that are growing. And so I think that's what you want to see. If you're a retailer, if you're an operator, you want to know that the consumer is going to give you credit for items that they believe that you think have value there, and you do not need to drive promotions. But as we saw since 2008, the companies that don't have that, they go immediately to promotions. During the pandemic, we didn't see them. We definitely are seeing them now.
Simeon, Elf stock up 30% year to date. Ulta, a company that you cover, their stock is up by about 12, 13% year to date as well. How much more legs did this little luxuries trade have from your purview?
You know what's fascinating? The fact that 12% year to date is an underperformer in my group right now. Like, I think that right before this, you were talking about rate cuts. In December, when we had conversations about rates coming down, the sector went through the roof. And so it's an interesting conversation. If you would have said Ulta is where it is right now 3 months ago, I think most people would have said that's overvalued. The fact is, when the market multiple grows up, we have to follow the individual stocks as well. And so Ulta right now is putting up good numbers. I think if you're putting up good numbers, people are going to allow your stock to go higher. If they were to look and say, okay, let me think about an intrinsic value of a multiple that I would have wanted to pay outside of what's been going on in the market, that would be a different story, but we don't operate outside of the market. And so I think when I look at that, and Ulta, you look at a company that is driving good results. Again, Bath & Body Works, tangential to that sector. You look at companies that are going to be driving good results, and if the gross margin holds, I don't think anyone's going to be selling these stocks.
Simeon, while we have you, I got to ask you, because I've been getting a roundup from some of the analysts that cover this company, Lululemon, and this men's sneaker launch. Look, I've been fascinated and really waiting for any type of results to see what the success of this launch was like. However, I can't even go in stores and get them. I'm talking to some of the associates. They're saying that I got to go online. They said after the company said that they were supposed to be in store, they're not in store. They had to ship it back. What is going on with this launch from what you know? I know you guys do far more channel checks than I do, even though I go like 2 or 3 times a week.
I was going to say, the pains of a sneakerhead here. Listen, I think that what Lulu has done so well is continue to drive the brand, continue to drive the core. The initiatives, the new product lines over the last several years, other than the belt bag in terms of what we've seen, maybe have been a little bit less so. So whether they're pitching it to you as Nike's scarcity value, I think these are not viewed as limited drops. I think these are things that you should, when they are finally rolled out en masse, you should be able to get them when you walk in the store. I don't think they're meant to drive this perception of there's just a limited amount. But I think the question ultimately for Lulu is whether people are still buying that core, whether it's your yoga pant or whether it's your ABC pant. That's what they need to drive, because at the end of the day, the valuation here is much larger. And so I think what I've been seeing, I think there's concerns right now that those trends have been coming down, and you can see that. I told you every stock in my group is up a lot. Lulu's not. And so I think right now there are concerns that all those channel check sneakers aside are asking about where's the core Lulu business, because that stock has run fantastically until this year.
Simeon Siegel, always a pleasure to get some of your insights. Thanks so much for taking the time here today. We know it's a busy week for you next week, but enjoy the weekend for sure.
Good to see you guys. Have a good weekend.
Absolutely. Earnings reports from travel companies showed that consumers are willing to swallow higher prices to get their holiday getaways this winter. All next week, Yahoo Finance will dive deep into what's in store for the industry this year. Travel is poised for a comeback. Wait, wasn't that last year? Well, we're poised to go into overdrive at least. High ticket prices, dwindling savings, and all that recession talk didn't slow red hot demand for planes, trains, and leisure spending across the board. Air travel, for one, rocketed back towards that all-important pre-pandemic level with no signs of slowing down in 2024. But with a new year comes new challenges. Will all that pent-up demand finally get tapped out? Will passengers finally get priced out? And will much publicized issues for giants like Boeing put a crimp on demand? And then there's the mighty C's, of course, the likes of Carnival and Royal Caribbean. They were on cruise control last year. The sector was the outperformer, but will operators increase rates for those still riding the post-pandemic fervor? Don't discount geopolitical risks either. Their impact on the price of fuel. Oh, and a host of new trends from astro to music tourism. Yes, we're talking Taylor Swift. There's lots to digest, but Yahoo Finance will tell you exactly what you need to know. Tune in to Yahoo Finance's Travel Guide 2024 Industry Insights beginning February 26th. Luxury EV maker Lotus Technology is debuting on the Nasdaq via a SPAC merger this morning. Amid dampening EV sales growth, Lotus Technology is gearing up to compete against U.S.-based companies like Tesla, General Motors, and Ford. Let's bring in Alexius Lee, who is the Lotus Tech CFO, as well as our very own Pras Subramanian, to discuss more. Alex, great to have you here with us today. So first and foremost, why this timing and what do you hope to achieve through this de-SPAC?
Thanks for having me today. I think today is a great day for us at Lotus. We want to use this opportunity to give special thanks to our shareholders, partners, and our own employees, and also our customers. Now, today is a great day for us as in mark milestone. We are here in the market right now. We have been here 80 years old brand with a global footprint. And right now, 4 models are offering the market. We are an early mover. And right now, being listed in Nasdaq through this transaction allow us to execute our strategy, develop our growth potential, and deliver our commitment to the market.
Hey, Alexa, this is Pras here. So you mentioned that global footprint. Is that something that's going to help Lotus Technology because of the fact that in the U.S. there's some dwindling EV demand here, but in places like China and Europe it might be better?
Well, right now we have 4 models, 2 sports car model, 1 SUV, and 1 sedan. So having that product portfolio matters a lot. These 4 models are currently available in Asia Pacific, and part of it is also available in UK and EU. We're having the new SUV model coming into the US the 3rd quarter of this year. So different markets have different strategy and different product offerings and different conditions. What is most important here is that we are definitely going to more markets at the same time through more models and through more stores.
So Alexius, the Electre EV, the SUV that you mentioned, I believe just started sales in the US here. How are things going? Are you able to share any numbers on how those sales are?
We began taking reservation orders. We'll begin delivering into the market 3rd quarter this year. This is an exciting product. We think that this is a product that will go through 50 distribution network. Right now, I don't have the numbers to show offhand, but we think that this is going to be a key maker given that we are in a segment of $80,000 to $150,000 price unit. And in this segment, we don't have a real competition in terms of performance cars at the same time with electrification options.
Alex, talk to us a little bit more about, in terms of this SPAC, obviously it's going to help with capital. How is that going to eventually, I guess, your plans to deploy capital in terms of production and really execute on your strategy and your vision in terms of competing with the market, especially given the fact that there is strong demand playing out in China?
Well, we have raised $880 million from this transaction. So this is a very good foundation that we have. This is a new chapter for Lotus. What is important here is that we have L. Catterton as a great partner, and they have great resources in both consumer insights and at the same time LVMH. This is a huge opportunity for us to develop a potential partnership in terms of co-branding, co-marketing, and others in a way to help Lotus execute a strategy and to develop our full potential in the fast-growing underserved EV luxury segment market. Now, what's more important here is Anish Malawani, who is the CEO for LVMH North America, will be on the board of Lotus Tech.
Interesting names there in the luxury space, LVMH and those executives, but also Geely is a Lotus owner. Do you anticipate leaning on them for technology in the future, potentially for maybe the introduction of hybrids in the U.S. that are so popular now?
Well, Geely has been a shareholder and at the same time an enabler that is empowering us in a way of manufacturing, R&D, and supply chain. We have worked very closely on many of these industrial footprints, and definitely our strategy from when we have decided, our strategy has always been on electrification and going through with 6 models in 10 years into the whole worldwide market. So we will be sticking to our electrification strategy and definitely having Geely as one of the enablers to help us with achieving our targets.
It seems like there's been a massive price war that's ensued. You are at the luxury end of this EV market. Have you had to adjust, even though you're going after a buyer that perhaps isn't as concerned about paying up to $100,000 plus for one of the, I might add, very nice looking electric vehicles that you produce? Have you had to moderate that at all? And how does that impact some of the margins that you're tracking?
Well, you make a very good point. We are actually in the luxury segment. Our price positioning is $80,000 to $150,000 US dollar. Now, in this particular segment, customers are not as price sensitive. And if I were to look at Oliver Wyman's research, you'll see that in this particular segment is the biggest volume contributor in the whole luxury space. At the same time, it's very underserved, and we are the early mover, as Lotus has made that full commitment to full electrification since 2018. Now that puts us ahead in terms of peers, and we definitely is likely to outperform the broader market. Now, based on this market research, this particular segment is going to grow about 35% CAGR for the next 10 years. So we think that we are in a great position, and given that we're listed in Nasdaq today, this is a new chapter for Lotus for us to be able to execute our strategy.
Alex, I'm curious, just real quick before we let you go, just how do you think about pricing right now? If you were to need to lower prices in order to make your cars a bit more appealing to consumers, is that something that you would, though, potentially consider given the environment?
We haven't seen a real pressure in terms of competition in this luxury EV space. We think right now we are in a space whereby we are still in the process of opening up more new markets, with new models, and at the same time opening up more stores so that we are able to deliver good customer experience to potential car buyers. So we are still at the ramp-up stage.
Alexius Lee, congratulations on this back today on the debut. We appreciate you taking the time. CFO of Lotus Tech, and of course our thanks to Pras Subramanian as well. All right, well, Carvana shares are surging this morning on the company's latest report here that we are seeing. You're looking at a jump of just about 36%. Clearly, there is a lot of optimism playing out on the street, Pras, given the fact that Carvana is much better positioned, or at least the belief right now, than it was compared to a year ago. You have revenue, though, on the other hand, did miss the street's expectations. What does this report really tell us about the positioning and the future of the company?
You know, I thought to myself, Carvana really pulled a rabbit out of the hat here. I mean, this company was, I hate to say it, was almost left for dead for a while. In fact, some of its competitors like Vroom did not survive. And I guess they beat on Q4 earnings, the adjusted EBITDA. They are able to improve their profit per car almost like double compared to last year. So I think they're cutting costs there. They're able to refinance a lot of debt and push that out. And they say that they'll have a better quarter. Even Q1 is looking good for them too. And the market is sort of normalizing. Used car prices are coming down. They're able to buy them more cheaply, and then turn them around and sell them to consumers. But I think Wall Street also is still a bit more fearful about the debt load that they have. It's a huge debt load, and it's kind of like how much can you keep refinancing, diluting your stock, and keep pushing that out? I think that's the question now. But today, the stock is up a lot.
Should investors be concerned at all, though, when you've got and you hear about companies like Hertz, some of the car rental companies that are saying, hey, we're going to get rid of some of our fleet, and that is now used cars that are entering into the market. So that supply being added in as another option for consumers to consider.
Right. I mean, your overall supply going up, so prices may come down. But I would argue Carvana probably buys a lot of these cars from Hertz. That's a big channel for them to bring in new cars to sell to their customers. So it's a give and take there. It's a dynamic, changing market. There's still a demand for cheap cars. People still need cars to get around. And I think that Carvana is now able to kind of capitalize on that market trend.
Well, if anybody is looking for anything else to get around, I've got some top tips here in New York, at least. It's a trek. Pras, thanks so much for taking the time here on the day. All right, guys, coming up, shares of Block jumping on the fintech's latest earnings results. We'll have the analyst reaction on the other side. Bitcoin edging lower after fintech company Block reported that it saw a boost in profit and revenue from the cryptocurrency in its fourth quarter. The company's gross profit jumped 90% from a year ago as the price of Bitcoin also rose in the quarter. Our very own Jared Blickery here tracking the moves in the crypto market. Hey, Jared.
Hey there, Brad. Yes, Square, otherwise known as Block, that is up 17% today. And crypto, Bitcoin specifically, makes up a big part of its revenues, about 43%, $9.5 billion for the reported quarter. But that is the revenue. The cost of that revenue is about 9.3 billion. So their gross profits, Bitcoin only makes up about 3% of that. But here's a chart of Block going back 2 years. What stands out to me is this is a lot of sideways action. We had a dip below late last year, a little bit of a scare there, but bounced right back into the range, and now we are climbing back to the upper end of that. But until we break out of, let's say, 90, probably not going to mean much. You do need to get that catalyst, and we'll see if we can get some momentum based on these latest earnings. But I just want to show in general that crypto-exposed stocks taking a little bit of a hit today. Riot blockchain down 7% there. And when you take a look at what's happened over the week, we see a lot more red than green. And let me just show you what's happening with crypto. I'm going to do a 7-day market look at this because we do have crypto trading over the weekend. Bitcoin still down 1.5%, Ethereum up 5%. And if I sort by performance here, you're going to see that a lot of the fringier tokens still have not taken off. We get some movement in Shiba, for instance, every once in a while, but that is only very recently. You take a look at the year-to-date returns here, and it's mainly Bitcoin and Ethereum with a few others like Trax thrown in for good measure. So we'll see if the rally can broaden out to include some of the fringier tokens, but there you go. Bitcoin up 15.4%. This is an incredibly bullish chart. I'm looking at over 2 years. Here is the low in 2023, and we're chipping away at that overhead resistance. We still have all of this price memory basically in here, but you get above 60,000. I think it's an easy bet that we take out the highs and then 100,000. But let's not get too far ahead of ourselves. We're only at 51,000, just barely right now.
All right, Jared, thanks so much for breaking down the movement that we're seeing there in Bitcoin. Let's talk about the results that we got here from Block, because shares are soaring here after the payment giant run by Jack Dorsey posted a surprising quarterly profit driven by demand for its Cash App service. You're looking at gains at just about 17.5%. Block also raised its adjusted EBITDA guidance for 2024. Let's get a deep dive into these results. We want to bring in Moshe Katri. He is Managing Director of Equity Research, IT Services, and Payments at Wedbush Securities. Moshe, it's great to have you here on the program. Talk to us just about these results. Do you think it reinforces the potential upside that we could see with Block shares?
Good morning, and good to be here. The results are driven, as you said, by two things. One is Cash App's performance. That's the consumer-facing product. It's kind of a digital banking platform. And then the other is the financial discipline that's very stringent that the company adopted. And it seems to be that management this time is very serious about unlocking the earnings power of the business. And I think that's really appealing to a whole new set of investors, potential investors in Block. And that's why the stock soared so much since the last earnings release, not only from yesterday. So I think there's definitely more conviction about the ability to unlock value, unlock earnings here. One part of the business that's still not doing well, and we believe that the company's doing whatever it needs to do to change direction, is seller or the merchants business or Square. That business used to be, that's really the core business that started the company. And throughout the years, they've built Cash App, and Cash App now is really driving growth. In merchants, the company seems to have slowed down materially. Some of it is competitive, kind of dynamic, and some of it is probably internal execution issues that that management is in the process of kind of addressing. And that's going to be another big deal. In our view, during the next 6-12 months, we should see an improvement in revenue growth for merchants or the seller business.
What is it that Block has laid out to give you that confidence that we would see some type of rebound in that merchant business? What is the point of sale? What is the hardware, the software that many merchants are demanding and seeing in some of those other competitors that they're not quite getting from Block right now?
It's beyond just a hardware piece. The company historically decided that it wanted to move to, from SMB to the mid-market. You need a different sales strategy. You need a different product mix. And all this is being addressed as we speak. On top of that, the company historically built its own products. And now, as we understand, management is kind of reconsidering that and deciding maybe to partner with ISVs, independent software vendors, to be able to appeal more in terms of the products that they're offering in their ecosystem. So there are a lot of these things that Jack Dorsey himself is focusing on, given the fact that the head of merchants actually resigned about 6 months ago. So he's personally in charge of kind of going through that transformation. The company did indicate that they've seen some positive indicators that the strategy is starting to work. So I guess we'll have to wait to see some more data points that proves it. But listen, they have the first mover advantage, and their products and ecosystem are actually really great. They just have to strategize better.
Actually, one thing that they are focusing less on is international. Is that a strategy that makes sense to you?
Yeah, one of those that's one of those levers that they're pulling to make sure that they're unlocking the earnings power. They've been focusing on international probably for about 4 to 5 years. We believe it's been margin dilutive. So it's not only the international piece that they're focusing less on. It's basically, disposing of unprofitable businesses. Title, for example, that's one of those businesses that they're probably getting rid of. I think it's a portfolio kind of enhancement strategy that they're going through right now, just given the fact that the core business is doing really well. And Cash App is just on fire. That's the digital banking product. So there's a lot of growth to kind of focus on without really kind of focusing on other areas that at this point haven't been as profitable for the company.
Moshe, when you think about how this company is going to get back to what they were laying out within this report, the rule of 40, rather, what is the timeline? How are you going to be tracking them up against getting to that target?
Well, first of all, they've been actually doing that. They're on track to get there. They started doing it last quarter. And I believe management is targeting 2026 to kind of get there. Mm-hmm. So you have a couple of years to go.
All right. Moshe Katri, who is the Wedbush Securities Managing Director of Equity Research and IT Services and Payments. Great to have you here with us today. Thanks so much.
Thanks, guys. Have a great weekend.
You too. Oil prices snapping a 2-week winning streak today. This comes after the Fed pushes back on rate cut timing expectations. To break it down for us, we have Yahoo Finance's very own Inez Ferre. Hey, Inez.
Hey, Brad, that's right. With Fed Governor Christopher Waller basically indicating that the Fed may wait a few months in order to cut interest rates. And what that would do is the market is interpreting it as perhaps impacting growth and therefore impacting demand. Part of the reason why you're seeing oil prices taking a step back. But nevertheless, we have seen oil running up to Brent crude up above $82 a barrel, WTI at around $77 a barrel. But take a look today, down more than 1.5%. As far as demand is concerned, I spoke to one analyst that told me, look, demand could surprise to the upside this year. Last year, demand came in better than expected as far as U.S. supply. This may not be that blockbuster year that we saw for U.S. output as far as oil is concerned. And then with respect to OPEC Plus, well, one analyst is telling me OPEC Plus may be reluctant to scale back their cuts this year because they really want to see oil prices pushing higher towards 90. I'm talking about the Brent crude levels. So unless we see Brent pushing up around $90 a barrel, OPEC will be reluctant to scale back those output cuts, guys.
Inez, thanks so much for breaking that down for us. Appreciate it.
Thank you.
Guys, coming up, all of the Magnificent Seven companies have finally reported earnings. We'll break down which companies had the most significant narrative shifts. That's next.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
All the members of the Magnificent Seven, Nvidia, Microsoft, Meta, Alphabet, Tesla, Apple, and Amazon, have reported quarterly results. We saw a couple of these tech giants come out of earnings season with significant shifts in their narratives. I have my eyes on Tesla, the brand, of course, of Elon Musk and those electric vehicles. I think the larger question, especially as we're taking a look at shares here, over the course of today, down by about 1%, but as we've been tracking this since earnings and over the course of this year, it's down 21% this year. What investors were looking for this company to say was anything around making sure that the pricing mechanisms that they've put forward were finally starting to subside here and that we could have some normalization. However, what we also have is this backdrop of the broader EV demand cycle. And that's where it hits on Tesla. It hits on Ford, it hits on GM. So for Tesla to, in this near-term period of time, also come out on this call and talk about some of the headwinds that they're seeing, even in other regions, as you've got BYD now making major strides in China, a core growth market for Tesla. I think that's where the shift is initiated here. And for investors, they're trying to wrap their minds around, okay, what type of liquidity position, free cash flow is this company going to have to continue to deploy in order to make sure that they're still outproducing on the EV front, while at the same time seeing uptick in some of the actual the actualizations of those productions and delivery figures within the markets. And I think that that's just the overhang right now that we're seeing playing out over these past several weeks.
Yeah, the higher rate environment making it even tougher for many people to afford these cars given the higher price tag. Yes, we have seen some of that drop in demand lead to price wars, but still, when you compare EVs to traditional cars, much more expensive. Many people still forced to stay on the sideline if there is that desire to buy an EV. All right, well, my shift in narrative that I wanted to talk about is Meta, because you got to give it to Meta and the turnaround story that we have seen play out at that company under the leadership of Mark Zuckerberg. Now, this is a stock that surged in its post-earnings trading. Now, we talk a lot about this week about Nvidia and how much it added to its market cap. Well, before we got those results, Meta added $197 billion to its market cap post its latest earnings report. That had been the biggest in stock market history before being dethroned by Nvidia yesterday. But the reason I bring this up also is because it declared its first dividend, showing that the executive team there is extremely confident in Meta's financial position going into 2024, obviously beyond. They've been able to increase engagement. They've been able to sell more ads. Their operating margin expanding to 41% from 20% a year ago. So this is a stock that has certainly really turned around momentum over the last 15 to 18 months. Investors are back on board. I think what people are asking now is how much more room there is to run with Meta when you got a valuation of where it is today. And that jousting that was just on. I like that.
It was pretty dope. Yeah, that was in the metaverse, or at least through the Quest, right? The Quest 3 mixed reality. So all these things considered, and I've been quoting Mark Zuckerberg. There's the actual metaverse that they were talking about. Jury's out on how that goes. But anyway, I've been quoting Mark Zuckerberg for about the past year now when he was talking about the 3 pillars of generative AI, where he basically laid it out, and I kind of repurposed it as AMC. It's the applications that sit on top of the models, the language learning models, and then those models sit on top of the chips, the data center, of course, and the cloud. The larger thing that we've seen within this positioning that they've been able to put forward, the major goal for them, they talked about this in the call, is going to be building the most popular and advanced AI products and services. And if they succeed, everyone who uses their services will have a world-class AI assistant to help get things done. Creators will have that, businesses will have that, and the state-of-the-art open source model to build with as well. So that, another potential additive here after 2023. That's in the rearview mirror. Year of efficiency, done. Now we're building stuff.
And they're still being pretty efficient too, in talks of their headcount and how they are spending. Certainly an approach that is staying with the company here in 2024. But it's all about AI. We've seen that excitement play out, and it is a focus for Meta. All right, let's do one quick check of the markets before we let you go. We got to take a look at the S&P. Right now, just below that 5,100 level, had crossed above it shortly after the open today. It is a level to keep your eye on here throughout the trading day. That does it for us. Keep it right here. Rochelle and Akiko have you for the next hour. We'll see you on Monday. Have a great weekend.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what I'm watching this morning. Surging ahead, Nvidia's market cap briefly tops the $2 trillion mark. The chipmaker joining an exclusive club with Apple and Microsoft as the AI rally pushes the stock even higher.
To the moon, shares of Intuitive Machines skyrocketing after the company makes history in orbit. Its lander Odysseus becoming the first commercial vehicle to touch down on the lunar surface, putting the U.S. a step closer to establishing a more permanent presence on the moon.
And Redditors unite. The social media company opens up its public listing to its most active users. Investors brace for the firm's long-awaited IPO, even as Reddit warns about increased volatility risks.
First, though, let's take a look at where markets are trading on this Friday. 90 minutes into the session, we are seeing the Dow and S&P 500 hitting fresh highs today. The Dow up 190 points. The S&P 500 briefly breaking above that 5,100 level. It's at 59.5 right now, up about 8 points. And the Nasdaq down about 29 points there. Let's take a look at where Treasury yields are trading today as well. We've seen some swings in that market this week on the back of the Fed minutes. Today, we are seeing all the yields pull back. The 10-year yield at 4.30%, the 30-year yield at 4.42. Well, we are looking at stocks, a bit of a mixed picture coming off of that AI-fueled rally after Nvidia's blowout fourth quarter report. Our very own Jared Blickery is here tracking the broader market action. What a week, Jared.
What a week, Akiko. And for all the talk and all the hype about Nvidia, and arguably it did live up to the hype, it hasn't been the best week for tech. And we can see the Nasdaq trading down about 0.25%, while the Dow is in positive territory for about 44 basis points. And we look at the sector action. I think this is fascinating. Today, utilities is the #1 sector, up over 1%. Financials and consumer staples on its heel. There's tech in third to last place, down about 0.25%. Energy is taking that final space down about 64 basis points. And when we take a look at the week overall, it's consumer staples that comes out ahead. That's kind of a Dow play. We got Walmart and Coca-Cola doing well after earnings. Then we have materials, that's XLB, then healthcare, then financials, then utilities. Those are the best plays of the week. No tech in there. In fact, we see communication services, which is a mega cap sector. It has Alphabet and Meta. That is the only one trading to the downside this week, worth about 0.5%. And when we take a look inside the semiconductors, this is over the last 5 days as well. We can see about an even mix between the winners and the losers. Slightly more winners, Nvidia taking the lead, up 8%. And then when we take a look at software, it's kind of a different story. I'm going to sort by performance. You can see more than 3/4 of these names are in the red. Some of these down quite a bit. Teladoc down 31%. We had earnings from PanW, that's down 24%. Shopify down 10%. So unprofitable tech, and we can see this in the disruption trade, did not do well this week. I'm going to go to the Dow. Remember staples? I was mentioning those Walmart earnings. Walmart up 4%. Coca-Cola up 3%. JP Morgan, a financial name, that has been trading at record highs. That's up 2.7%. Dow looking a little bit healthier this week than the Nasdaq. And this is, again, a 5-day look. Apple, one of the few mega caps trading to the downside, 0.6%. Tesla also down there, down 3%. And when we take a look at the intraday, we can see a lot more red than green, especially in the mega caps. And finally, just a look at the market cap readings here. Nvidia had ticked above $2 trillion, but now at $1.954 trillion. You need $800 per share, and it's at $782, $800 to hit that $2 trillion mark again, guys.
We'll see if it can get there and stay there. I mean, when you look at some of the price targets and things, you do expect it to get up there and stay there.
My money's that it will.
I mean, you think, I mean, it would just have to. Appreciate you, as always, our very own Jared Blickery. Well, we're continuing to dig into the tech-fueled rally today. Nvidia hitting that $2 trillion valuation briefly and setting a record for the biggest daily market cap gain this week. Now, this comes after the chipmaker handily beat analysts' expectations in its earnings report and guidance. Markets riding high on Nvidia's win, but the rally might need broader participation to survive. To break this down for us, Keith Buchanan, Global Investments Senior Portfolio Manager, is here. Thank you for joining us this morning here. So, Seeing a little bit here, a bit of movement here in the Nasdaq pulling back this morning, could be some profit taking. But what do you make of the rally here, and what we should really think about when it comes to broadening out beyond that hyper focus on Nvidia?
Hi, and thanks a lot for having me. At our shop, we view the rally as being justified to an extent. The valuations of these corporations, Nvidia, kind of putting a highlight on things, the fact that they're growing and how they're absolutely walloping expectations. The valuations on the next 12 months earnings, price to earnings basis doesn't look that stretched. Honestly, 30 times earnings for Nvidia, when the broader market is trading at 20 times for the S&P 500. This isn't a very stretched marketplace from the Mag 7 standpoint. There are a couple that trade at higher valuations. Nvidia trades, again, 30 times. Apple's trading more expensive than that. Microsoft is as well.
Keith, let's talk about your top picks here. Easy to forget, we've had some other results coming through this week. We kicked off the week with retail earnings. And Walmart certainly one that really impressed in a big way. We're going to see if we can get Keith back up here. It looks like we've lost that connection, or we've got his connection frozen. We'll see if we can get that going here. But let's talk about another stock that is moving in a big way. Intuitive Machines stock soaring today. This coming after its spacecraft becomes the first privately developed lunar lander to successfully touch down on the moon. NASA capturing the very moment the lunar lander named Odysseus landed on the lunar surface.
We can confirm, without a doubt, is our equipment is on the surface of the moon, and we are transmitting. So, congratulations, IM team. We'll see how much more we can get from that.
Intuitive Machines posting an update this morning on its official X account saying the lunar lander is alive and well, and flight controllers are communicating and commanding the vehicle to download science data. And Rochelle, we did hear from NASA Administrator Bill Nelson yesterday saying this shows the power and promise of NASA's commercial partnerships. And it really does point to just the fundamental difference in the way that we are seeing space exploration move forward, at least in the U.S., with an agency like NASA really leaning in on these commercial or private partnerships. NASA awarding $2.6 billion to 14 different companies that are developing lunar landers. Intuitive, just one of them, but still other launches in the pipeline this year.
It's true. And you think about this really laying the groundwork. As you mentioned, there's some of these public-private programs that NASA has, and what that means for the space economy. I mean, we've been talking a lot about, SpaceX and sort of, them spinning off and IPOs and things, but it really is about this groundwork that's being laid here. And when we look at some of the experiments that are being carried on this lander, you've got 4 commercial payloads, 5 science experiments for NASA, even some sculptures as well. So really broadening the horizon here. It does seem to be a very new landscape that we're in now. And they are targeting the moon's South Pole region. And so the agency is hoping to land some astronauts in that same part of the moon as well, as part of its Artemis program coming up. And of course, a lot of people wondering what's next, when will we see the next lunar landing there. So I'll be curious to see, but obviously a wonderful start and a fascinating development, and hoping everything comes back with lots of good information there from those scientific experiments, Akiko.
Yeah, the South Pole is certainly going to be critical, because that's where the expectation is there is some water on the lunar surface. If they can establish that, then the expectation would be that you can take that a step further so that you could have a more permanent presence on the moon. But stay tuned is what Bill Nelson said, and we'll be watching very closely to see the next big mission move forward. Well, shares of Rivian and Lucid hit new all-time lows on Thursday after reporting quarterly results that disappointed the street and also raised concerns that EV makers are not evolving quickly enough, particularly with electric vehicle demand slowing. While analysts have pointed to several reasons for an EV slowdown, our next guest believes Stellantis is best positioned among its peers. Let's bring in Tom Narayan, Global Auto's lead equity analyst at RBC Capital Markets. Tom, it's always good to have you on the show. We're talking about Rivian and Lucid. These are upstarts in the EV space. Are we starting to see more and more of a divergence between the big established names like a GM, Ford, Stellantis, and then some of these upstarts that have really tried to shake up the EV space?
Yeah, that's actually the kind of the main question we've been getting all week, especially after those results is, thematically, there seems to be now a divergence between the kind of pure play upstarts, if you will, and the legacy OEMs. And we're starting to see that, the legacy OEMs, they do have an advantage here. They can produce ICEs and plug-in hybrids, which are now getting a lot of interest along with full electrics. So yeah, I mean, and I do want to say, one thing about the outlooks that we saw from Rivian and Lucid, et cetera, from these pure play guys and also the legacy guys is it's not that EVs are declining or anything bad. It's the rate of growth is slowing. And we're starting to see the early adopters who grabbed a very expensive Rivian or a Lucid for that matter. Those guys already bought a lot of those vehicles. And now the mainstream consumers coming in to buy EVs, they're kind of more price sensitive. That's where a lot of the demand is coming from now. And that's really what the legacy OEMs, the Stellantis, the GMs of the world are selling. So it's also a function of that. A lot of these kind of more affluent buyers, so to speak, have already bought their EVs. Now we're getting into the more mainstream buyers. But the EV slowdown is being felt everywhere. Mainstream buyers are also price sensitive, and EVs cost quite a bit of money today. So those prices have to come down, and that will kind of benefit the whole industry, especially the legacy OEMs.
Yeah, the differentiation there between slowing growth rate and declining sales, certainly an important one. You talk about this push towards more plug-in hybrids, at least that's what consumers are looking at. Does it ultimately come down then to a more diversified portfolio / lineup? Is that why you like Stellantis?
Yes, exactly. So I would say Stellantis, Toyota notably, and to a lesser extent BMW are the car makers that early on, they chose to do a flexible architecture approach. What does that mean? On the same line that they make full electrics, they can also make ICEs and plug-in hybrids. So if there's more demand for ICEs and plug-in hybrids, they can just change and make more of those. So that's really why it's benefited a name like a Stellantis, like a Toyota, like a BMW, and why we favor those names that have more dedicated architectures that can only make full electrics now are facing some problems, right? Because all they can do is make BEVs. So if the demand for those slowed, it's not like they can switch and pivot and make plug-in hybrids. So yeah, that's probably one of the main reasons why we like a name like Stellantis. It looked like a mistake maybe to a lot of people a few years ago when they chose this approach, but now they're looking like the smartest kids in the classroom.
And so, Tom, of course, we have to talk about some of the pricing strategies here, especially when you look at pure play EVs. You sort of almost saw this sort of race to the bottom a little bit with those price cuts. But when you're a Stellantis, where it's part of your ecosystem, are you under pressure then to compete on that level, or can you afford to keep your prices, higher, especially given you still have your ICE vehicles, which people would also perhaps like to see some more deals on?
Yeah, that's a great point. That was we just had actually this Stellantis management on the road with us a couple of days ago. And this was the number one question they got is, can you maintain these really high pricing? And certainly some of this pricing probably has to come down. I mean, the pricing for them is up something like 40% in the past 3 years alone. But what we learned is that while pricing can come down, it doesn't necessarily mean that profitability suffers. The reason is right now dealerships give a pretty high incentive amount. So even though the MSRP is very high, the incentive is also high, and the dealer kind of gets the credit for it. So what Stellantis wants to do is negotiate better with their dealers so they can come out with a lower MSRP, a lower sticker price, and a lower incentive from the dealer as well. So I do expect pricing to come down. But the other benefit Stellantis has is they're predominant in the US, at least, it's Jeep and it's Ram. These are premium products, very sticky consumer base. They can sell a lot of plug-in hybrids there, which is where demand is. So I actually think they can hold on to price better than some of the other car makers who are more in more competitive spaces like crossovers and sedans.
Tom, Stellantis CEO Carlos Tavares, one of many executives that have warned about the potential entry of Chinese EVs, particularly BYD, into the U.S. market. Elon Musk saying that if you don't have the tariffs in place, it's going to destroy other car makers. Carlos Tavares, on the other hand, saying, look, this is going to be significant, but we'd rather compete head to head. Is the threat that significant, or you think it's a bit overstated?
I mean, it's a little bit of both. You're right. I mean, I think Carlos Tavares definitely wants tariffs, right? So he's going to definitely, there's a rationale to say that this threat is very severe. But the threat isn't small either, right? I mean, the Chinese OEM, especially BYD, has some very compelling products. We learned that the Chinese OEMs have a 40% cost advantage over Stellantis. Some of this is labor, but a lot of it is vertical integration and how they work with suppliers. So there is an advantage, but there's some mitigating factors here. So in the US, you do have a 27.5% tariff that already exists. In Europe, it's about 10% tariff. Also, it's really only going to be an issue, I think, once the Chinese OEMs have local production, right? BYD's talking about a plant in Hungary and then a plant in Mexico. That's going to take a few years, right, before they have those plants up and running. So there's some mitigating factors. In Europe, though, I probably am more concerned over Chinese OEMs coming in. Europe, it's much difficult to put on higher tariffs. Also, the types of cars that the Chinese OEMs make is more competitive with what the Europeans do. But in the US, it's a lot harder to do this. You have the IRA. There's a Trump administration. There's probably could be some restrictions there. Also, the Chinese make EVs predominantly, full electrics. And in the US, full electric penetration is slowing the growth rate, and it's not as robust as it is in Europe. So, and also you have pickup trucks and SUVs where the Chinese OEMs aren't doing. So I'm less worried about the US for the Chinese threat, more worried for Europe.
All right, I appreciate you taking the time to join us. Tom Narayan, Global Auto's lead equity analyst at RBC Capital Markets. Have a great weekend.
Sure.
All right, we have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. The tech-fueled rally continues, although losing a little bit of steam today. But Nvidia hitting a $2 trillion valuation and setting a record for the biggest daily market cap gain this week. And this comes after the chipmaker handily beat analyst expectations in its earnings report and guidance. Markets riding high on Nvidia's win, but the rally might need broader participation to survive. To break this down for us, Keith Buchanan, Global Investments Senior Portfolio Manager, is here. Good to have you on the show here. So, Keith, what is it going to take then to take some of the steam off of this rally that we're seeing and really broaden out some of the gains more?
Thank you so much for having me. Really, AI is as real as advertised. There's no denying that this is a revolutionary form of technology that will change every industry and how productive we are as a society. But the sheer market cap that these corporations have garnered to this point is really hard to really fathom. I mean, there are two corporations that individually have more market cap than the entire Russell 2000 small cap index. We feel like the market has become a little too top heavy. We've enjoyed some of the gains of the Mag 7, so to speak. And we don't feel like the valuation is extreme even at these levels. But we feel like this rally at this point is going to have to enjoy broad participation within value, within small cap, within mid cap, in order to continue to sustain itself later into 2024. From a valuation standpoint, we feel like that can benefit those corporations that execute very well. We saw some of that last quarter as far as earnings reports, especially guidance. I mean, we're looking at those corporations for leadership going into 2024.
And it's interesting because when you look at the price movement that we've seen in the valuations, a lot of people's wondering about that balance between rational exuberance and meme stock treatment here. So in terms of what could potentially let the steam out of this rally, what are you looking at?
Look, irrational exuberance is when we make up different new ways to justify where things are. Pex.com and price per click, price per book in some areas, price per website visit in the 90s was a symptom of that exuberance. We're just not seeing it now. The most traditional earnings metric of price to earnings on a go-forward basis, next 12 months. Nvidia is trading at 30 times earnings. I mean, the market, S&P 500 is trading at 20 times. It's trading cheaper than Chipotle, cheaper than Costco, cheaper than Amazon and Microsoft as well, and even half the valuation of a Tesla. We just don't feel like we have that exuberance just yet. And that's because the earnings expectations have actually outpaced the stock, if you can imagine that. So we don't feel like we're at excessive levels yet. We just feel like the broadening could help sustain this rally further later into the year.
And Keith, Nvidia's performance this week overshadowing all other stocks, but we did kick the week off talking about retail earnings, and you've got Walmart as one of your top picks. What do you like there?
Call me old-fashioned. I like execution, and that's what Walmart has proven time and time again. In the heart of the pandemic, coming out of the pandemic, they were able to keep prices ahead of inflation. Now the inflation is starting to turn down lower. The Vizio purchase, I think, really is an example of where they see the corporation 10 years from now. Walmart is going through an Amazonification, if you will, of their business as they're seeking different avenues to push advertising to online customers. As we saw more high-earning customers come through their doors, their virtual doors, and actually get products through their e-commerce, being able to push different advertisement to that new cohort of Walmart shoppers is really integral to where they grow the firm, grow the company over the next 10 years. Vizio just plays a big role in how a different channel to get those advertisements to those customers. We like the way that Walmart is executing going into a future Walmart that could look a lot more like Amazon than Walmart of the past.
And Keith, I have to ask you about Eli Lilly. You called it the AI of healthcare. Give us your base case for that and what you're looking at.
Sure. If AI has a promise to make our entire society more productive, and Nvidia has the best products that will lead that charge, I think the similar case can be made for Lilly as we approach how obesity affects their patient base, which is the entire U.S. and world population. Zepbound is a product that we feel like will be the flag bearer for those weight loss drugs going forward. Lilly has pushed this drug, and it's been really efficacious on a level that we just haven't seen with the other classes of drugs. They have to approach the payers and make them willing and able to get these products to their patients. We feel like that's a bridge that will be crossed as the payers have too much to lose in keeping these products from those patients that desperately need them. We already know how obesity affects the human body over time. It causes much more damage than this would cost. So the cost-benefit equation will be reimagined over the coming years. And we feel like Lilly is in perfect position to take advantage of that.
And finally, Keith, where do small caps fit into your larger portfolio right now?
Small caps we actually have small cap as part of our exposure for our clients. The Russell 2000, again, has not gained really any traction on a relative basis to S&P 500. The Max 7 has led that group much higher than the Russell 2000 has grown. The Russell 2000 also has a profitability problem in that almost half of the group is not profitable at the moment. So we feel like opportunities can be found in that profitable segment of the Russell 2000 as that, again, as we mentioned in the previous few minutes, as that performance spreads out among not just the top 7 corporations, but those that offer promise, offer story, offer earnings and cash flow growth across market cap. We feel like the larger, more profitable, more cash flow producing corporations within the Russell 2000 should stand to benefit from that trend as well.
Keith Buchanan, Globalt Investments Senior Portfolio Manager. Good to talk to you. Have a good weekend.
Thank you.
Well, social media site Reddit filing for an IPO on the New York Stock Exchange after filing confidentially in December of 2021. A lot has changed in the competitive space since then. Reddit up against the likes of Google, Meta, and then the tech game changer of large language model AI. Rochelle, this is the first significant social media IPO since Pinterest debuted in 2019. So there's a lot riding on that in terms of what the appetite is going to look like. You look at what Reddit is looking at right now, valuation of roughly $5 billion. That is about half of what it was valued at back in its last private financing round, 2021. So that shows you kind of where things are right now. But I love how they're kind of taking it back to sort of the original Redditors, setting aside shares for the top users, moderators as well, which is not something that you see often in IPO, where institutional investors have the in.
I love that. It's kind of a nod to the community that is Reddit, that, when you think of meme stocks, you think of people, tapping away on their devices, really fueling this. So a real sense of community here. So a nice nod to them. I did think it was interesting in terms of the competition that they listed in this S1 filing. A lot of them are companies that they have tie-ups with, including Google. On the content and communication side, they included Google, Meta and its suite of offerings there, YouTube, Wikipedia, Snap. When it comes to the user economy side, they said they're also competing with existing online marketplaces. Your Reddit saying your Facebook Marketplace, Nextdoor, Craigslist, Poshmark. And then interestingly, because when you think of Sam Altman's OpenAI CEO there, obviously in really the face of all large language model AI, talks about growth and engagement here, and one of the competition that they named, ChatGPT, Gemini, and Anthropic, in terms of what this means for perhaps shifting some of the customers and the users who would have been on Reddit looking for some of these alternatives. And of course, some of these companies, especially Google and Meta, snapping up most of the ad dollars here, and advertising is one of the key ways that Reddit makes its money, Akiko.
Yeah, we were just talking yesterday about that partnership that Reddit has now signed with Google to be able to use their data for their AI. So certainly going to be a lot of questions about what those additional sources of revenue are going to be for Reddit moving forward. But it's been 18 years since the company began, certainly gone through an evolution, if you will, when you compare it to the early days of the company. Well, coming up, we speak with Jennifer Granholm, U.S. Secretary of Energy, on the state of clean energy, where the administration is placing its bets right now. You'll hear what she has to say. That's coming up after the break. Energy Secretary Jennifer Granholm is touring the country touting the Biden administration's investments in infrastructure for clean energy. The president's Inflation Reduction Act set aside billions of dollars in tax credits and incentives to accelerate the transition. But nearly 2 years on, the U.S. remains well behind its goal of reaching a net zero economy by 2050. I asked the secretary what she sees as the biggest gaps in the clean energy supply chain as she pushes to reduce U.S. reliance on China for critical minerals and technology.
I'm in a construction site right now that is with Group 14, who are building an anode factory with silicon for batteries for electric vehicles. China, as you noted, they control about 90% of the supply chain for batteries for electric vehicles and critical minerals. What this company is doing, and this is with help from the bipartisan infrastructure law, thanks to the president's Invest in America agenda, they are producing anodes for batteries that don't have graphite. Graphite is one of the critical minerals that China has had export controls on that we can't even access. So this is one example. There are 500 manufacturing facilities that have announced they are coming or expanding in the United States as a result of the president's Invest in America agenda, just on the clean energy side. So it is super important that we have identified the gaps in the supply chains. We are funding responses to those gaps, meaning inviting investment for the private sector to come and fill those gaps. It is really exciting because these factories are growing up in every pocket of America. And here in Moses Lake, Washington, this is one of those pockets.
You've certainly taken sort of a two-track approach here. One of it is about the transition to clean energy. It's also about bringing more manufacturing back to the U.S. You certainly have companies out there that are competing in this space who say, look, it is great to really focus on countries of origin, making sure that the components are for friendly countries, but at the same time, they're going up against competition from China where they are competing at a much lower cost. How does the administration support some of these companies as they say, look, we want to be a part of this transition, but we don't know if we can compete at this cost?
Yeah, that's exactly why the president's agenda was so well thought through. First is the bipartisan infrastructure law gives grants, and this particular facility that I'm in right now got a $100 million grant from the bipartisan infrastructure law. But in addition to that, the Inflation Reduction Act also provides tax credits for manufacturing these components in the United States. What that does is bring down or starts to level the playing field from the other countries who are also providing incentives for their companies to stay there. So we're in a battle. We have not been in this battle before as a country, meaning we haven't had the federal government partner with the private sector before in the way that it is doing now to level the playing field and make America really the irresistible nation to invest in for this clean energy revolution. This global market for clean energy products is going to be about $23 trillion. And these products can be made anywhere. But what the president has said is we want them made in the United States. And that's why this public-private partnerships happening all across the country, fueled by the Invest in America agenda, is so important.
The adoption of EVs, of course, a critical part of this transition to a green future. Last year, we're coming off of record numbers of new EVs sold, but we're starting to see increasing caution from drivers who are saying, I'm not sure I want to take the leap, considering, number one, the cost, and then the lack of infrastructure that's in place. The administration has said you want 50% of new cars sold in the U.S. to be EVs by 2030. When you consider the rate of growth right now, can you still meet those targets?
Yeah, we can. I mean, the EVs are really growing very fast. I mean, it was double last year what it was the year before. We're projecting that same kind of uptake this year. But here's what the administration is doing to address the two concerns that you raised. One is there are tax credits for electric vehicles made in the United States for buyers. So you can get a $7,500 tax credit off at the dealership if the car is made in the United States. You can also get a $4,000 tax credit at the dealer if you buy a used car. So that's an important thing to reduce the price up front. There's a lot of new models that are coming on from our domestic manufacturers that are much lower price as well. But in addition, we want to make sure that people don't have what is known as range anxiety, that they can find a place to charge no matter where they are. First of all, a lot of people don't even realize that you can plug in an electric vehicle in your garage if you have a garage, but not everybody has a garage. And you can charge it up that way. And it is so much cheaper to operate an electric vehicle, meaning that you don't have to fill it up at the gas tank. It saves you hundreds of dollars every month, depending on how quickly you fill up. But we want to put charging stations everywhere. And so that's why under the bipartisan infrastructure law, again, part of the president's agenda, there was a $7.5 billion investment to put charging stations all across America. 500,000 charging stations are starting to pop up. All the money has gone out to the states. They are starting to install those charging stations. We're putting them every 50 miles along transportation corridors, and we're putting them in rural areas and in places where the private sector has not put in those charging stations to fill in the gaps. So you're going to start to see a lot of that construction happening this year as well. And the charging stations we're seeing are made in America now too. So all of that is feeding on one another, and we're trying to do as much as we can to address all of those concerns at once.
Finally, let me ask you about the LNG export pause here. I know you've gotten a lot of pushback on the back of the announcement. You've said that, look, this does not undermine confidence in U.S. LNG. I wonder, as you think about how to evaluate these individual projects, how has that evaluation process shifted as a result of the impact of climate change? Does that factor in bigger now that we're looking at what the fallout is?
Yeah, it's a really important question, and this is why the pause is simply to do a study to assess one of the reasons is to assess the question that you just asked. What is the impact of demand for fossil fuel energy globally when all of these countries, for example, have said that they are going to reduce their dependence on fossil fuels, and more countries are doing that and have enacted policies to do that? What is the impact on our national security? Meaning we want to supply our allies with natural gas, and we are doing that. And this pause doesn't affect any of those authorizations. But into the future, shouldn't we be looking at where the global trends are going and what our allies need? And also, what is the impact on greenhouse gas emissions overall? And importantly, what's the impact on prices at home? If we are exporting, half of our natural gas, which is the amount we've authorized, what does that do for prices for those who use natural gas at home? Those are the kinds of things that we are looking at: the economics, the national security, the climate impacts, the impacts on the people who live in the surrounding these liquefied natural gas terminals, as well, is something we are looking at. All of that data is being taken into account by our national labs, and so they're doing a modeling evaluation based upon those factors, and that's required under the Natural Gas Act. We are not allowed to approve terminals unless it is in the public interest. And so we have to evaluate, what does that mean to be in the public interest? And that's exactly what we're looking at.
The president's senior advisor, Amos Hochstein, was recently quoted saying he thinks the pause will take anywhere from 10 to 14 months. Is that the timeline you're looking at right now?
I know it will take some months. We haven't said that exactly, but it's the national labs that will be doing that, and they've got a whole array of modeling capabilities. It doesn't happen overnight, but it will take some months to do it.
And that was Energy Secretary Jennifer Granholm. Our thanks to her for joining us from Moses Lake, Washington. Well, the Biden administration is announcing new sanctions against Russia in response to the recent death of Russian opposition leader Alexei Navalny and the wake of Russia's invasion of Ukraine. Let's bring in Yahoo Finance's Jen Schomburger to discuss more. And Jen, we should note that this marks 2 years since that invasion.
That's right, Akiko. And to mark that 2-year anniversary of Russia's invasion into Ukraine, the U.S. Treasury, in concert with the State Department, are unleashing more than 500 new sanctions against Russia's military, payment system, and countries that have been assisting Russia. Among the litany of new sanction targets announced today, one of Russia's financial rails of commerce underpinning what's known as the Mir payment system. It's basically the alternative to Western processors like Visa and MasterCard. As well, 2 top 50 companies by revenue in Russia, and SPB Bank, which is owned by Russia's second largest stock exchange. The new sanctions would also hit the whole supply chain of Russia's defense industry, including defense companies, companies that help defense companies like machine tools, as well as companies in the automation, lubricants, robotics, and software areas. Treasury also targeting 37 entities and individuals and countries assisting Russia, including China, Serbia, and the United Arab Emirates. The new sanctions come as the U.S. tries to continue squeezing Russia and stop further attacks on Ukraine. At the same time, the administration is pushing House lawmakers to pass aid the Senate's already approved to Russia. Treasury Secretary Janet Yellen saying in a statement this morning, quote, "We must sustain our support for Ukraine. Even as we weaken Russia's war machine, it is critical that Congress steps up to join our allies around the world in giving Ukraine the means to defend itself and its freedom against Putin's barbarous assault." Now, today's actions bring the total number of sanctions against Russia to 4,000 over the past 2 years. Guys?
So, Jennifer, with that in mind, then, you mentioned 4,000 sanctions at this point. So how much pressure is this actually going to add? How effective could these new sanctions be realistically?
A great question, Rochelle. Analysts are actually saying this is expected to deliver a limited blow. And the reason for that is the Biden administration is a bit limited in its options here. The administration, in concert with Western allies, have imposed an oil price cap, which the administration says is working. If you look at Russia's economy, the number one revenue generator is oil and energy. And while that may be limiting Russia's revenues, it's not stopping them altogether. And Western allies in the U.S. really want to avoid an outright oil embargo because that could send energy prices skyrocketing, which would be detrimental to the U.S. and global economy. Now, today we also have Senator Schumer from the Senate leading a delegation in Ukraine to try to put pressure on House Republicans to pass aid for Ukraine that the Senate has already passed. Unclear whether that is going to work in their favor as the Republican Party remains torn on this issue. The House not expected to be back in session until next Wednesday.
I appreciate you getting us up to speed on all the latest there out of DC. Our very own Jennifer Schonberger. Thanks so much. All right, coming up, how financially prepared are you to handle a health emergency for your furry friend? We break down how you can avoid going into debt for your pet. That's up next. Would you go into debt for your furry friend? Well, a quarter of people would do just that to get life-saving medical care for their pets. That's according to a NerdWallet report. And a USA Today survey finding 91% of dog owners have experienced financial stress over pet ownership costs. But there are ways you can keep both your pet and wallet healthy. To break it down for us, Kimberly Palmer, NerdWallet personal finance expert, is here. Good to have you on the show here. It does seem like a lot of people underestimate just how much some of these health-related costs for pets can really run you at a time when people can barely afford to prepare for a $250 emergency. What do people need to know about this?
What's really hard about pet care is that you really don't know what to expect. You don't know whether your pet will become sick or injured. And the time to buy pet insurance, which can help you manage those costs, is well before your pet needs it. And so it's really important for people to consider, what do you expect? Do you want to be able to turn to pet insurance if your pet does need some medical care, or do you want to pay for that yourself? And in some cases, risk even putting your own financial situation at risk. As you mentioned, people are willing to do a lot for their pets, including go into debt, and that can be really challenging for pet owners.
But you think if people are willing to go into debt, why then not take the insurance? Compare some of the costs that people could be looking at monthly if they do have insurance versus some of the costs. I know anecdotally for me, my dog ate a piece of chewing gum and was allergic to it, $9,000 later. But if you don't have pet insurance, that's an upfront cost you have to bear.
That is such a great example of the kind of unexpected expenses that can really come up for pet owners. What's important to know is that you can often buy pet insurance at a relatively affordable price. So for example, the average cost for pet insurance for a dog is about $53 a month. It's important to know though, and this is something that surprises a lot of pet owners, the price of your pet insurance actually goes up as your pet ages. And at the same time, because of inflation, we're seeing the price of pet insurance go up anyway. And so pet insurance is not cheap, but it is definitely more affordable than if you suddenly have to pay for these unexpected medical bills because your pet does either get injured or need some kind of medical care.
As you look at some of the more expensive things that some of this pet insurance does and doesn't cover, what do people need to know in case they think, right, I've got pet insurance, I'm covered? Because there are some outside costs that are also in addition.
There are. What's so important to know is that in general, you pay for a deductible when your pet needs care. And then the pet insurance kicks in to cover a percentage of the remaining costs. So that's why it can make it so much more manageable to handle those costs. But an important thing to know is that pet insurance generally does not cover pre-existing conditions as well as wellness care, unless you add that on to your pet insurance, which of course makes it more expensive. And so the tricky thing for pet owners is that if you know your pet needs some kind of care because it already is sick, for example, it's probably too late to get pet insurance at that point because of that exclusion of the pre-existing condition. So a lot for pet owners to consider.
And so then when you think about that cost versus, say, all the other costs that people have to take on at a time when inflation starting to moderate, but still very high for some of these costs, how should people think about incorporating some of these costs so that they're not hit with a shock if there is an emergency for their pet?
That is really the important question, and it's why it comes down to an individual decision. So what you want to do is weigh the risk of suddenly being faced with some big ticket items because of medical care for your pet versus pet insurance, taking that out now, maybe when you first get a pet and you're evaluating, what kind of risk do I want to take on? You could set aside money on your own and budget ahead of time for those kinds of expenses that can come up, or you can turn to pet insurance where you're paying a monthly fee, an annual fee, and then you can go to pet insurance if you need it when your pet needs some kind of medical care. So it's something to weigh the pros and cons of, think about your budget and what might fit into it. What you don't want to do is to put yourself at risk and, take on debt that is really hard to handle, because that can lead to even more financial stress down the line.
Yeah, that peace of mind premium, certainly worth the cost if you're able to cover it. Appreciate you breaking that down for us. Kimberly Palmer, NerdWallet personal finance expert. Appreciate you taking the time. Have a great weekend.
Thank you.
All right, coming up, shares of Warner Brothers discovered sinking after missing estimates in its fourth quarter. One analyst has a surprising recommendation for the media giant. We'll discuss next. Shares of Warner Brothers Discovery plunging today after missing expectations on the top and bottom line, currently down, as you can see, about 11%. On the bright side, though, its streaming service Max did end 2023 on a high note, posting profitability for the first time. Yahoo Finance spoke to Rich Greenfield, Lightshed Partners media and technology analyst this morning, and he seems to think that despite this turn to profitability, streaming just isn't working for WBD. This is what he had to say.
We think they have to shut down the Max strategy. I think we've been pretty vocal, very vocal, that Max is a flawed strategy. You already see them starting to license a large part of their content out to Netflix. I think the idea of trying to build something far bigger just isn't working.
And so in talking about profitability, he also tweeted, essentially rewriting a Hollywood Reporter headline, saying WBD gets HBO back to slight profitability after wiping out $2.5 billion of profitability prior to the Max launch. So clearly putting this in context and really not sold on the Max strategy here, Akiko.
Yeah, I mean, although they did reach profitability before the other streaming services, right? So whether that's in fact a one quarter story or whether that momentum continues is another question. I mean, David Zaslav saying that we're a far healthier company and we're building real momentum. Of course, we have seen WBD really move forward on some of those cost-cutting measures over the last few years. I thought it was also interesting that Rich Greenfield talking about this sports bundle and that he was a little surprised that Warner Brothers Discovery's in it as well because of the very issue, Rochelle, we've talked about, which is potential for cannibalization. Warner Brothers, along with Disney and Fox, they do have some of their other assets in cable. The question is still out there about whether, in fact, consumers, once this bundle is out there, decide, I don't need that cord anymore because I've got the sports, and that's the only reason I've kept that cord going.
It's true. And when you're sort of looking at other paths to profitability, we know that David Zaslav talked about the rollout of Max in international markets, perhaps looking for some growth there as they're not getting the type of growth that they were hoping to perhaps see with the market here. Also looking at subscriptions, also a bright spot in the global market for them as well. So still a challenging environment, but obviously Greenfield, they're not really sold on Max and how it's performing, but perhaps international markets could perhaps offer some relief in that regard. All right, well, look, we're going to get your final check of the markets as we're heading into the noon hour. Still looking at a mixed picture here. The Dow, though, still down at the moment. You're looking at the Dow and the S&P 500, the only ones in the green. Dow there, just down, but ever so slightly, down about 15 points. The S&P 500, just with slight gains as well. The Dow, strongest gainer as we head into the noon hour, up 135 points. Of course, not quite the rally that we saw after those Nvidia earnings. Some of that tempering expectations and seeing the tech industry, the tech sector at least for the Nasdaq, under some pressure this morning. Well, that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thanks for watching Yahoo Finance. Have a great weekend.